Hello everyone, and welcome to day 3 of the study school for ACCA paper P7. I hope all of you can see the slides in front of you. Also, just some routine housekeeping instructions to start off the day. First of all, if you have any questions, please feel free to put them in the question text box that you have on your screen. There is a moderator here who will be available to say the questions out loud so everybody else can also hear them, and I will be happy to respond to them. We have covered 2 days in the past, and you can see that in the green shaded on the area on the slide. So we started off with the introduction and regulatory environment and covered a lot of ground on ethics and what are the good exam techniques on ethics. Tendering and money laundering was also covered on the first day. Then we moved on to the second day where we discussed a bit on practice management, in particular ISQC, the quality control standards, ISQC 1 and ISA 220. We then moved on to the risk assessment part and the audit strategy part after having gone through some of the theory around audit risk, business risk, inherent control and detection risks, and how risks are supposed to be taken out of different scenarios, and doing a little exercise with regard to how better you can write risks. We moved to a case study actually, which was question number 1 of the December 2015 attempt of ACCA paper P7. The agenda for today is going to start off from where we left yesterday, and that is going to revolve around the risk assessment again, but that will now be combined with 2 different approaches. One is going to be the group audit approach, which is something that has been tested fairly regularly now. It has become a regular feature in the paper, thanks to globalization of the world, and as you are well aware of the fact that more and more companies now have subsidiaries and more also now have foreign subsidiaries. So group audits is obviously an area that is continuing to be tested more frequently now, and the marks with regards to group auditing in a typical exam paper can range from anywhere between 15 to 25 or 30 at times. We will then do a quick refresher of some of the basic financial reporting standards today. So there are a lot of slides to cover today, but there will be some reading time as well that will be given to you so that you could in your free time also go through those slides. Not all financial reporting standards can of course be covered in a single P7 session. So as I said earlier, it is expected that at the P2 level, the knowledge that you have gained is likely to come into play when you are going to solve your paper for paper P7. We'll move to the audit response stage based on the financial reporting knowledge that we would have built and some of the key audit areas around those accounting issues that we will be covering today. And it is for this reason that in today's agenda we have 3 questions that we need to practice. Before we will be moving on to that, we will start our proceedings by doing the 600 and 700 series of the RSAs. So we will start proceedings there accordingly. There will be a little mention, if time allows, of audit reports. Although the key feature with regard to the audit reports, which is the new feature, the CAM, Key Audit Matters, is supposed to be started off tomorrow. But however, I would like to have a general discussion around what are the audit report and what are the basic contents of the audit report as per the new ISA 700, and of course doing a refresher of the major types of modifications to the audit opinion or the audit report. And that of course involves, as you're well aware, the adverse opinion, disclaimer of opinion, and qualified opinion. So the 3 types of modification to the report or opinion that can happen. We will also discuss in a very brief detail the emphasis of matter and other matter paragraph, but we'll be covering that more tomorrow when we discover what is a key audit matter, the new standard IEC 701, which is part of your syllabus. That's a new addition to the syllabus and likely to be tested as well in the coming attempts. So to start off, what are the standards that we would be doing? But before that, it's good to ask if there is any question coming in from yesterday or day before.
Yes, exactly. There are 2 questions before we begin. There's a long question from Mr. Singh. Question from yesterday lecture. I have read once in the examiner comment that the answer that you produced by the examiner is considerably long. Students are not expected to reproduce that much long under the exam condition. I would be thankful if you can give us an example that how we shall reproduce, especially in risk assessment questions, and please rewrite one or two risks from the exam questions as an example.
Okay. Rewriting of risk will take some time, of course, with the little code that I have. However, it's a very good question, and we discussed this yesterday as well, just before we were signing off. Yes, the ACCA answer is a model answer. It is the best answer. It is something that would be expected perhaps maybe from very few percentage of the best students who are getting right there the highest number of marks. It is something that is probably not expected of the average candidate. The ACCA has developed a model answer in order to help candidates like you to assess what should be the good or the best quality answer that should be given. And it is totally understood that that may not be achievable in exam conditions, in the 3 hours that are available to you for the writing time. So, yes, it is understood, and you are obviously not likely to be able to write that much. However, as I said yesterday, and I emphasized, that is like a benchmark, and you have to be as close to it as possible. So the key thing is not about the length, of the answer itself, or how long the response is, if it's 1 page or 2 pages or 5 pages long. Rather, it is what we talked about yesterday, precision. So you have to be precise in your answer. So whatever has been asked, that exact question requirement needs to be addressed. If there is something that is in addition to what the examiner would have expected, there are no obviously additional marks available, which is why we always refer to the marking scheme, because the marking scheme is given to anybody who's going to check the paper, and they are going to make sure that if the points have been made and they are valid, so they will get marks accordingly. So anything that's out of the park, out of the whole scenario, something that is irrelevant, is not likely to fetch many marks at all. Having said that, of course, this does not mean that a risk that should have been described in sufficient detail should be limited to just 1 or 2 short sentences. Sometimes you have to describe a risk in sufficient detail. For example, we'll talk today about going concern, ISA 570. So in order to say that there is a problem with the guardian entity's going concern, you obviously need to have 4, 5, 6 factors that are triggering going concern. So in the P7 exam, it would not be expected that you would just come up with 1 or a few factors and very short descriptions and then just say a sentence that this will lead to going concern. No. You will have to describe it in sufficient detail and depth as to why those factors could actually lead to doubts over the entity's ability to continue beyond a period of 12 months. So you will have to develop your answer as well. So what is the good way to do it? Well, the best way to do it is exam practice. Practice, practice, and practice as much as you can. With each risk that you write, each paragraph that you write, always after having written that, compare it with the ACCA answer, see how well is it described in the ACCA answer, and how well have you described it, and what are the gaps. The lesser the gaps are as you move along towards that date of your exam in early December, I think the better it is for you and the higher chances of passing.
Can you please comment whether in question 1 we will be asked to recalculate any data available? For example, in the question yesterday we had profit margin, EPS, etc. Furthermore, do we need to calculate any other ratios when such a question comes up in the exam?
Definitely. We talked about this as well yesterday. Whenever she or he, whoever the examiner is giving you some numbers in the paper, definitely there is some reason behind that. There has to be some reason. So if there is, for example, an analysis that says that the prior year figure was 2015 figure was X and 2016 figure is Y, so obviously there is some expectation that you would be doing some analysis on it. And usually it is expected that wherever numbers are given, some analysis is done, which is why I recommend many candidates not to just get too bogged down with just the English text that is written in the paper. Rather, also pick up the calculator, do some calculations, do some analytical review and analysis, and realize and try to come up with different risks that could basically be interrelated as well. So sometimes what happens is that all you're trying to say is that the sales are increasing and the cost of sales you have not seen at all. So you are unable to comment on whether a risk is around the GP margin, which is increasing or decreasing, or whether it is around the revenue recognition. In fact, if you look at it thoroughly, there could be a possibility that there are 2 separate risks. One is on the revenue recognition, and one is on the cost classification or incorrect classification, leading to a GP margin erosion or otherwise. So sometimes you have to have a look at why the number has been given, and there has to be a reason behind it. So you should try and do as much analysis as possible. Also, one good exam technique practice would be as far as your practice sessions for paper B7 are concerned, that whenever you do question 1 and 2 and there are numbers given, try to pick up the calculator and calculate as many ratios as you can. And then compare those with what the ACCA suggested solution has covered. So perhaps you will realize in most of the cases that many of the calculations that you would have done would also be appearing in the ACCA model answer. So, which basically explains the point why the numbers are there in the first place.
So is there a chance that the ratios given in the exam can be incorrect and you'll be asked to calculate the correct ratio?
There is a possibility sometimes. It is rare, but I will not say that it does not happen. There have been cases, a few in the past, where some incorrect ratio has been calculated as part of a report that has been prepared, for example, by an audit senior or a member of the staff of the audit team. And then you actually calculate that and you figure out that there is a calculation error over there. So we'll also do a question today which will have a similar kind of a problem, which is not basically ratio. It is telling that the director's report says that sales have increased by 20%, whereas in actually, if had the candidate picked up the calculator and done the calculation, they would have realized that it was not 20%, rather it was some other percentage, 5 or 7%. And those candidates who did not pick up the calculator to check whether this percentage is correct or not, well, they could not get that mark. So sometimes, yes, it can happen, and you may have to check, but it really depends on what the structure of the question is.
Last and very short question. Do you really need to mention the entire name of the IAS or just IAS 38, etc. is sufficient?
For the financial reporting standards, obviously, I think from any professional accountant's point of view, in the real life, in the real world, we never use those long names that all the accounting standards have. So we tend to use the shorter versions, IAS 36, IAS 16, IAS 38, and that is the better way to go about it. For the auditing standards, however, yes, the names are too long. It is not expected that you would be knowing the exact name of each and every standard. Rote learning is not something that is encouraged either at the ACCA P7 level. So what is expected is, yes, if you know the number, it is good. It's good to write it. It's a good practice, and it creates a good impression on the examiner that, yes, you know that, for example, ISA 240 relates to fraud. But you do not have to state the whole name of the standard. So, for example, I'll just give an example. ISA 240, name of ISA 240 is the auditor's responsibility in relation to fraud in an audit of financial statements. Now, that is a really long name. But what do you have to do here? You don't have to write the full name. All you can say is the ISA dealing with fraud 240 states that, and you just do whatever on a 2 in front of that. So you can just state whatever the requirement of the standard is. So you don't have to say that the whole full, long name of the standard. Hope that helps. All right. So now, as you can see, I'll just give a snapshot of what we have to cover in the first part of the day today. First, we'll start off with the 600 series of standards, and that includes ISA 610. That relates to using the verb of internal auditor. Then we'll move on to ISA 620, using the verb of an expert. Something that has been examined many times. It's tested in the paper many times, and it is something that you should expect in your paper as well. There could be a small reference to it. Sometimes it's just 2-3 marks, but sometimes there is much more to it than meets the eye, and you have to write a bit of detail about what are the basic requirements with regard to ISA 620. We'll also cover some of the 700 series of standards, which is other than in relation to reporting. And those are 2 standards. So basically, we'll do ISA 710, which relates to comparatives, and ISA 720, which relates to other information. Now, again, the name of this standard is probably quite long, even the revised version that we have on this standard. So if you look at which of the standards have been revised, well, 720 is the one that has been revised recently. So we need to bear in mind what the changes are, as they could appear in your exam. Also, 610 is a relatively new standard, so I won't say that it's very new. There have been a few changes in the last couple of years or 3 years that basically relate to using the work of the internal auditor for the purpose of the external audit. So we'll start off with this. When we cover ISA 710, there will also be a connection with ISA 510, which is initial engagements, opening balances. So we'll talk in a bit detail about what the relationship of ISA 510 on initial engagements and the work that an auditor is supposed to do on opening balances is with regards to comparatives, which are presented within the financial statements. We'll start off with ISA 610. As I said, this is something that The ACCA has been there in existence for a considerable number of years. However, the recent change that came about was with regard to using direct assistance with regard to the external audit of financial statements. Now, if you can see on the screen in front of you, IC 610 basically highlights three things for external auditors to consider when making use of the work of the internal audit function. So whenever they're going to rely, or they're going to say that we're going to make use of the internal audit function, they're going to see understanding and assessing the role and scope of the internal audit function in the organization. Now, what that basically means is trying to understand how important is the internal auditor in the organization. Is the internal auditor or the internal audit department given an annual plan that they have to follow? Are they given sufficient importance? Do they have the role in the organization whereby their voice is heard? Who receives the reports that they prepare? Is there any action that is taken on those reports? So those are the key factors that you try to understand, because you want to know whether the internal auditor has a role and scope that is sufficient for you to aid you in the external audit. Also, the timing of liaison and coordination is important. And lastly, the evaluating specific audit work to ensure that it is sufficient and appropriate for the auditors to base their opinion on. Steps 1 and 2 are part of the process of identifying and assessing the risk of material misstatement. Now, this is something important to see, because when you are in the planning state of the audit, that is when you are trying to understand the role and scope of the internal auditor. So there is a possibility that you have done part of the audit and then you move to the execution phase, and there you realize that, well, I could have taken use of the internal audit department. Maybe they have done some work around inventory, for example, or fixed assets, for example. So, and an example of this could be a very practical one is telecom companies. So wherever there are telecom companies, you would know that there is a large number of infrastructure equipment that they have, and they place that all around the country. Now, as an auditor, you may want to have assurance about whether the infrastructure that is spread around, let's say if this is the country, well, there's no country that has a circular border like this, but let's assume so, and this equipment is spread all over this country. Now, as an auditor, you cannot possibly be at each and every dot or instance wherever the infrastructure equipment is on the 31st of December, let's say. So what you do is that you rely on the physical verification exercise that has been done with regard to the infrastructure equipment of the telecom company by the telecom company's internal auditor. So you use that work and you make sure that the existence of this fixed asset, which is appearing in the statement of financial position of the telecom company, has been ensured. Of course, you will in addition be doing your own procedures as well, but this is definitely something that is going to aid you or assist you. Now, what is the phrase that IEC 610 uses? The phrase that has been used by IEC 610 is using direct assistance. So this standard previously used to be named considering the work of internal auditor. And now we are talking about using the work of the internal auditor. So it's like you are making the internal auditor like a part of the team that is going to perform the external audit of your financial statements. Now, obviously, there are certain questions that come to mind with regard to this situation. Number one being independence. How can somebody who is an employee of the company actually perform something or a service that is purely considered as being done by someone who is independent of the entity? Which is why there are rules and regulations around what can be given to the internal auditor, what type of direct assistance can be used, and wherever direct assistance is used, what types of activities need to be performed by the external auditor to make sure that the work has been done by the internal auditor appropriately. Now, this would include, have the internal auditor sufficient and adequate training to carry out the work? Can they actually do that? Because sometimes you see, you go to audit your clients and you figure out that the internal audit department is not really trained well. And they are just people who do not have a lot of finance knowledge at times. Sometimes you figure out that the internal audit department just has finance people and no technical people. So there is not much support available with regard to, for example, ensuring that there is no technical impairment. Are the internal auditors proficient in their work? And this would not just involve what the qualifications are. This would also involve what kind of work they are doing. What is the quality of the reports that they are producing? what is the quality of the work product that they are delivering, and whether there has actually been an improvement in the processes of the company brought about by the internal auditor's work. Is the work of assistants properly supervised, reviewed, and documented, and are the conclusions reached appropriate given the evidence obtained? So these are some of the key things that you would be doing as an external auditor when you are evaluating the specific work done by the internal auditor. I hope that it is not confusing when we say external and internal, so it should be clear that you're talking about the external auditor using the direct assistance of the internal auditor. Now, further, the matters that need to be considered on the next slide are reports produced consistent with the work that has been undertaken? So, for example, there could be an instance where the work that has been done is entirely different, and the report that is being given is basically telling some other facts and circumstances, and that may not be really relevant for the audit. Sometimes the internal auditors are doing certain things that may not be directly relevant to the external audit. For example, they may be having a look of the customer complaint center to find out how many minutes on average is being taken to resolve a complaint. Now this is, well, maybe an important KPI for the company that they must resolve all complaints within 10 minutes or 1 day or 1 hour. However, from an external auditor's point of view, and the risk of material misstatement, anything going materially wrong in the financial statements, perhaps not likely to be a very important or significant reason. So the external auditor would only be interested in the work that is being done by the internal auditor that actually relates to the financial statements or could have a bearing or an impact on the financial statements. Have any unusual matters been discovered by the internal audit department, and have those matters been resolved? Are any amendments to the external auditor's program necessary due to the work? And has the external auditor sufficiently tested the work of the internal audit function to confirm that it is adequate? Now, what are the key requirements with regard to this particular area? One is that you will not give, as an external auditor, the only kind of work that you can give has to be low risk. So high risk and judgmental areas cannot be handed over to or delegated to the internal auditor. So whenever you're using direct assistance from the internal auditor, as opposed to previously where you used to consider the work done by them, you will be giving them only low risk areas. Second, there is also a prohibition on giving any areas that involve judgment. So judgmental areas, it may also be presumed that judgmental areas are generally high risk. However, there can be a situation where this could be treated separately. So, for example, you will not involve the internal auditor in evaluating whether the provision for obsolescence of inventory, or whether impairment, or whether provision for doubtful debts against receivable is adequate or not. So, this is something that is a judgmental area, and this is something that the external auditor would want to do themselves. Also, there has to be adequate supervision. So there should be an adequate supervision of the work that is being done. This is while the work is done. And then, after the work has been done, there should be a process of adequate review. It is not something that you just delegated to the internal auditor and they gave you the report and you put that in the file. No. As they are members of the organization, they are employees of the organization, and obviously not as independent as the external auditors are. There is also an additional responsibility placed on the external auditor by the IAC 610, the new version, that there should be a process of adequate review. Now, what does this review entail? This review basically entail what are known as check-back procedures. This is perhaps the only place in the standard where you would see the word check. So the check-back procedures are basically tests that are done to ensure that the internal auditor has actually carried out the work in accordance with the requirements of the external auditor. So what the external auditor would do is that they would, on a sample of the work that has been done by the internal auditor, go back and review the whole process and carry out the whole process again to determine if the same results and the same conclusions would have been reached had the external auditor themselves done that particular work. So in this case, the check-back procedures, for example, on inventory perhaps would involve actually, going there and making sure that the inventory is there at the same amount, or in themselves checking or having a confirmation performed to make sure that the inventory was there listed as that quantity level within the records of the organization. Now, from an exam technique point of view, this standard could be tested either in section B or sometimes and rarely in section A questions, either question 1 or question 2 as well. So it is important to note that whereas it is not expected that a whole full-fledged 20-mark question perhaps would come on ISA 610, there is always expectation that a part of a question could arise that would relate to using direct assistance from the internal auditor. And this is why ISA 610 is important. We shall now move on to the next standard, which is ISA 620. If there are any questions with regard to ISA 610, please feel free to put them in the question text box.
Okay, there's one question from Muhammad Osama. If internal department team have valuation expert that is highly aware of inventory valuation, can auditor rely on them or recruit external specialists?
It's a good question, and it depends on the actual situation where they are, because inventory and the value of inventory is usually in many industries something that is subject to considerable professional judgment. Because IS2, of course, requires that inventory has to be valued at the lower of cost net realizable value. Now, net realizable value is actually an estimate, and whether that estimate has been done appropriately or not by the internal auditor is something that could be questionable. So, for a manufacturing organization, for example, which has a significant amount of inventory and calls into question the valuation of that inventory on the part of the external audit, I think it would be advised that since it is a high-risk area, it would probably be better for the external auditor to themselves directly obtain the required evidence. And if they are unable to do so because of certain technical specifications within that inventory, of course they could hire an expert on their own, which is also our next topic. So how do they take the expert and what are the key areas around that?
A few more questions.
Sure.
Yeah. From Hassan, can you please explain how bullet 2 in the last slide, giving a practical example?
Okay, bullet 2 in the last slide, which was slide 58. Have any unusual matters been discovered by the internal audit department been resolved? So what happens sometimes is that the internal auditor is usually, as I said, given a plan. And as part of the plan, they are performing the internal audit exercise on a particular area. Now, what could happen is that while they are doing their work, which is their routine work, and not something that is related to, I would say, to using direct assistance, they actually uncover or discover something that is unusual or new. And that could be an irregularity or perhaps a fraud at times. So, in all those cases, the external auditor's alarm bells would also ring, and they would want to know that what that unusual or significant matter is about and whether it impacts the financial statements and in any way impacts other areas of the audit work that is being done by the external auditor.
There's a question from Saifullah. Is the audit work reviewed on a sample basis or does it not increase the ROMM?
The check back procedures that I talked about would usually be done on a sample basis. Of course, you would not be checking back on each and every work or task that has been given to the internal auditor. That would actually be duplication of the work done. However, the review has to be done of everything that the internal auditor was delegated with. So all the tasks that have been given to the internal auditor will be subject to review by the external auditor.
And very nice question. Is code of ethics applicable to internal auditors also?
If the internal auditor is a member of the ACCA, then part A of the code of ethics, which is the 5 fundamental principles, would definitely apply to the internal auditor. So they will have to act with integrity, professional competence, and due care, and all the other 3 principles. However, since they are not independent of the entity, so the principle of independence would not apply to them. Which is why the ISA has additional responsibilities with regard to reviewing their work. Good, thank you. We will now move on to the next standard, which is ISA 620, something that is usually a favorite of the examiner, its peers, and also a favorite of the candidates, because whenever anything technical, anything too technical comes in with regard to valuation or confirmations or existence of certain asset or liability, that is where what clicks into our mind is using the work of an expert. Now, there are 2 types of experts that could be used: the auditor's expert and the management's expert. So, first of all, it is very common to see management of an entity actually having used their own expert. And this is done around many different areas. And key examples of these we will just discuss in a short bit. And the other situation is related to the auditor's expert. So where the auditor themselves basically bring in an expert to perform certain procedures, and they provide the external auditor with assurance with regard to the, for example, the value of a certain item. Now, what would be the areas where experts could be used? Usually, in most audits that we get to see, actuaries are used to value the retirement benefit obligations. So, for example, if an organization has a pension, or what is also sometimes known as gratuity in certain countries, so what it basically entails is that people who retire will get a certain amount, which will be the last drawn salary multiplied by the number of years of service that they have done at the time of retirement. Now, today, an organization would not know that at the time of retirement of each of the employees, what is the amount that is likely to be paid to them, because they do not know what will be the last drawn salary, and they do not know perhaps when they retire or leave the organization how many years of service they would have achieved. So those are the areas where actuaries are involved, and actually come up with demographic assumptions as well as other assumptions about financial and economic indicators, and they come up with an amount of liability that should be recorded in the financial statements. Similarly, there could be some other technical experts. For example, in the oil industry, you get to see that oil reserves need to be valued, and oil reserves, which are basically something that is, well, underneath the ground, has to be reviewed and assessed with regards to their quantity and, of course, the value that needs to be assigned to them in the financial statements. And the reason for this is, of course, that oil, as it is under the ground, is also including some certain impurities and crude elements. So that crude oil has to be refined into purified form, and that is when you realize what the real value of the oil is, which is the purified oil. So that is also an area where these are used. There could be many other examples that could be given, and the list could turn long. However, I will just take one more example, which is, for example, the valuation. So, for example, an entity has a building, which is the asset of the entity, and the entity wants to know what should be the value that should be assigned to that building in the statement of financial position. So, an expert is hired who comes up with a value, which is of course an estimate, and that estimate is then used to record the value of the building within the statement of financial position as per the revaluation model of IAS 16. So those are all the areas where the experts could be used. Now, whereas there could be situations where management is using their own expert, there could also be situations where the auditor may want to use their own expert. And why would those situations arise? We'll just have a look at that once we go through the items on the screen. Number one, an expert is a person or firm possessing special skill, knowledge, and experience in a particular field other than auditing. So this person is not an auditor. Well, perhaps auditing is not his forte or expertise, area of expertise, which is the expertise of the external auditor. So he could be a valuer, he could be an engineer, he could be a biologist, he could be a microbiologist, he could be a doctor, he could be a chemical engineer, or an oil expert, an oil industry expert, or he could be an actuary or a valuation expert, but not an auditor. So IAS 620 identifies 4 issues for an auditor to assess. Number one, whether it is necessary to use an expert, the competence and objectivity of the expert's scope of work, and the actual work of the expert. So those are the 4 things that would be looked at as part of IAS 620. What? Green is not good. Okay, I'll just not use that. So whenever now the expert has been used, for example, by the management, so the external auditor comes in, reviews the qualification, the competence of the expert, whether they have credentials in those areas, whether they have the ability to deliver in those areas, particular areas, and that is where the auditor satisfies themselves that the work that has been done is adequate, they have the right skills and resources, the proper level of independence was applied, and impartial opinion was given by the expert. However, wherever the auditor feels that the management's expert may not, for example, be independent, or may not have exercised the right amount of due care and skills and competence, or there are certain assumptions that have been made by the management experts which the auditor believes are unreasonable or challengeable to that extent. The auditor may determine that they want to use their own expert. So the auditor would bring in their own expert, and the same level, the same criteria would be applied, which is what you see on the screen, whether the expert is competent and objective, he will do an impartial inquiry into the affairs, what will be the scope of the work, and the actual work of the expert. Usually also a question arises with regard to the fee arrangement. So usually what happens is that when you are accepting the audit client, and you know that this audit client, the audit of this client would actually require an expert. So you build that into the audit fee calculation, and you bill that to the client whenever you are done with the audit. There could also be a situation where initially you realize that perhaps no expert is required. And once you move along and you do the audit and you're doing it and you figure out that, no, this is a highly technical area, for example, oil reserves or valuation of building. So that is the area where you may want to have an expert. So that's where, a fee overrun bill would be done, and it could be discussed with the client that we need to do this, and this cost is additional to what we had agreed because the scope was slightly differently understood. And if the client agrees, of course, you can put that in an addendum to the engagement letter. So those are the key things that are important around experts. You should expect to see to utilize this, the name of the standard, please numberize 620 using the work of an expert. And wherever the area is high risk, you may want to consider whether the auditor's expert should be used in addition to having reviewed the work of the management's expert. Moving now to ISA 710 and ISA 510. We will do a question that will cover many of these areas in tandem. So there's not going to be one question dealing with just one area. As I said earlier as well, that the ACCA paper P7 actually contains the whole breadth and depth of the knowledge of the syllabus. So there will not be just one question focusing on one topic. Actually, the one question worth 20 marks may be covering 3 or 4 different topics. Now, talking about ISA 710, and there will be a short relation of this to ISA 510 as well. But let's start off with ISA 710. Opening balances. So there can be two types and comparatives. Comparatives, as per ISA 710, can be of two types. Usually there are two methods by which the comparatives are presented. One is known as the corresponding figures. Corresponding figures. And the other is known as comparative financial statements. Corresponding figures is when you have this piece of paper on which you have got the assets and liabilities listed, and you have two columns. So you have for each item a column for 2016 and a column for 2015. So there are two columns, and so line by line for each item you can see what is the value as of 2016 and what is the corresponding value for 2015. However, comparatives could be presented in another form, and some countries and some jurisdictions have this method of presenting them. That is that there is a whole page on which you have just one line item, which is the 2016. And this is how the whole set of documents of the financial statements is structured. So there are, like, let's say 20 pages that just go about having one column. And then from page number 21 to 40, there is another set of documents which has same information as was presented in 2016, but that is related to the prior year, 2015. So this is 2016, 20 pages that contain just the line items and the numbers for 2016. And after these 20 pages, from page 21 onwards until page number 40, you have same amount of information, same amount of pages that contain similar information, but just one column, which is for 2015. So these are two different ways of presenting comparatives. Now, the auditor has responsibilities with regard to corresponding figures as well as comparative financial statements, depending on which has been presented in the financial statements. And this is what is dealt with by ISA 710. Now, what is the overlap with ISA 510, or the overlay with that? ISA 510 basically deals with initial engagement opening balances. So it will only relate to situations which are the first audit situations. So for example, this entity that you are going to audit was not a company in the last year. It was a partnership. And it just converted into a company, and hence, as per the law of the country, it is now required to have its financial statements audited. So in that situation, ISA 510 would come into play because this is the first year of the audit. Also, it would apply where this audit firm that has been selected to do the audit is being appointed as the auditor for the first time, and the opening balances were audited by another auditor. So that would also apply. But there would then be an overlay with ISA 710, because ISA 710 also talks about situations where you are auditing 2016 numbers and 2015 numbers are either unaudited or audited by another auditor. So these could be situations which could be covered, and we are going to cover them in tandem and also realize what are the differences in scope of ISA 510 versus ISA 710. Opening balances, first of all, on the screens in front of you. The definition is that opening balances are those account balances that exist at the beginning of the period, reflecting the effect of transactions of the preceding period and its accounting policies. The auditor shall obtain sufficient appropriate audit evidence that opening balances are correctly brought forward. So this is the first requirement of the standard, that you have to make sure that the brought forward balance that you have, which is the starting balance for the year under audit, is correctly brought forward from the prior year, and which is the balance of the prior closed trial balance, which agrees to the audited financial statements. So this would be slightly, there will be some tasks that need to be done to achieve this particular objective. And for this purpose, what you do is that you take the audited financial statements and they will be matched with the grouping of the accounts that are appearing in the trial balance. And that closed trial balance of the prior year should then form the opening trial balance, because all the items within the income and expenses would be closed down to nil, and the retained earnings, the effect would be given in the form of retained earnings, either profit or loss. So that would then translate into a zero profit or loss, and then that's where you start off with a revised or refreshed retained earnings into the new year. Secondly, they do not contain misstatements material to current year figures. So now this is the main requirement. And this is where usually there's a lot of work that needs to be done. Because whenever the audit client is new, you do not know the client and how the numbers have been made up in the prior year. Usually it is good practice, and it is done practically in many parts of the world, that you contact the predecessor auditor, of course through your audit client, and you want to review the audit files of the predecessor auditor. What you want to do is that you want to make sure that the audit that was done for the predecessor auditor or the previous auditor, that audit was done applying similar principles, not same, but at least similar principles to what you as an audit firm would have applied. And hence you are gaining assurance that the numbers that have been brought forward from the prior year, the audit that you did not do in the prior year, so the numbers that have been brought forward are actually free of material misstatement. And if there was any, for example, error on the part of the auditor, or mistake or negligence perhaps, that has been taken into account when you are bringing the opening balances forward. Also, the third thing that you want to make sure, which is the objective of the standard, is that accounting policies are consistently applied or changes have been adequately disclosed. There is a possibility that in the prior year, the accounting policies that were applied were different, and now from 1st January onwards, in the period of the audit that you are doing, the different accounting policies have been used or are being used. So what would happen in this case is that you would make sure that the effect of the accounting policy change has been adequately described as per IAS 8. And that would come into play because IAS 8 deals with changes in accounting policies or fundamental errors, if there are any that have been identified. Now, incoming auditors, what are they doing? That they are testing opening balances, which can be difficult, of course, for new auditors, because they did not audit the prior year figures, and we just talked about that. So they should ascertain whether prior period report was unqualified. This is the happy situation whereby there was no big problem identified by the prior auditor or the predecessor auditor. You go review their working paper files and you figure out that a good quality audit had been done, and you are happy with the figures that have been reported, which are going to form the basis for your opening balances. Also, other steps that you would have to undertake discussions with management about opening figures, because you want to make sure that whether management is contemplating any adjustments to those balances, whether there was anything that has come, new knowledge has come to light after the report had been signed, for example, and also thirdly, undertake substantive procedures on opening figures if concerns arise. So sometimes it may be important that you go through the audit files of the predecessor auditor and you are not satisfied with the amount of work that has been carried out on the closing balances of that year and the opening balance, which are going to be for this year. Or alternatively, the audit was not done at all because, as I said, it was a partnership in the prior year. So what do you want to do on the opening balances? Well, you would want to take certain substantive procedures on the opening balances if you have concerns. Now, what would these opening balances be? And does that mean that you actually start digging into those opening balances so that you're auditing the whole numbers game ever since the company was formed? No, you're not doing that. The reason for this is that you are only responsible for this year, the audit year, let's say in my example, 2016. So you are not actually going back to when the company was formed and auditing each and everything, because that responsibility belongs to the predecessor auditor, if there was any. However, you want to make sure that there is no material misstatement in the opening balances that continues to be material in the closing balances of 2016. So if there's anything that is wrong in 2015 or prior to 2015, the effect of that should be considered in 2016. And if there is none, then you are fine and you can take the opening balances for 2016. Now, comparatives, as you can see, are the corresponding amounts from the preceding period, which are part of the current year's financial statements. They are distinguished from comparative financial statements, which the auditor's report should refer to separately if they exist. So those are the two that you can see on the whiteboard here, that the corresponding figures are basically where on the one single piece of paper you can see the 2016 figures and the 2015 figures as well. Whereas on the comparative financial statements, you have a separate set of papers, the whole document that pertains to 2016, and then there is a separate set of papers, a whole bunch of documents that relate to 2015. Now, what will continuing auditors be doing? They will check balances have been brought forward, and this is a situation which is less risky because you have been continuing as the auditor, so you know what the closing balances were in the prior year, and you just make sure that they have been brought forward appropriately as opening balances for this year. If unresolved prior year problem is material to the current year, modify report due to opening balances and comparatives. Now, this is a situation that could be tested in the exam. And how would this be tested? Well, a short scenario may be given, worth 3, 4, 5 marks maybe. And this has happened a few times as well in P7 history. If we look at the history for the last 5-7 years, that there is a problem with regard to opening balances for 2016 because in the 2015 audit, there was, let's say, an error. Let's take an example. Let's say that in 2015, the weighted average of inventory was not properly calculated. Now, what would that have caused? That would have caused multiple problems. One, the valuation of inventory, the closing inventory for 2015 is incorrect. Number two, the charge to consumption in the P&L for 2015 is incorrect. What does that lead to? Number three, the profit is incorrect. What does that lead to? Number four, the tax calculation is also incorrect. So there are multiple problems with regard to 2015 numbers, right? And let's say that this is material to the current year. That adjustment to the P&L, had you not made the error, is important, it's significant and material for 2016. Please bear in mind that the problem arose in 2015, 1-5. And now that problem has been discovered in this year, in 2016. So what would you do? You would modify the report for 2016 with regard to opening balances and comparatives. The reason for this is that you want to make sure that the shareholders know that the 2016 financials, well, the audit and everything else that was done, the P&L, is fine. However, the opening balance that was used coming in from the prior year contained a misstatement. So it is your responsibility to tell that in the audit report. And hence you will modify your audit report for 16 with regard to the misstatement that arose in 2015. If it is material to current year, but opening balances are not affected, the report should refer to comparatives. And that could include a modification or an emphasis of matter paragraph. A same situation, if it arises in the case of comparative financial statements, it would be different. The reason for this is, why is there a higher risk over here? Because on the same piece of paper, you are giving two numbers, two columns. So there could be a chance that the shareholders or anybody who is reading the audit report may believe that the audit has been done for both these numbers by this firm, which is not the case actually. So you would want to tell that to any person who is reading. However, the risk is lesser when you are doing comparative financial statements. Why? Because there are two separate pieces of sub-documents within the main document. So anything that is wrong here would be reported on the report for 2016, but anything that is wrong over there would only have to be referred to in the form of an emphasis of matter or a modification, if that is so important for 2016 audit report. The incoming auditor with regard to audited comparatives is responsible for comparatives as part of current year accounts. Other matter paragraph is included in the auditor's report, whereby the incoming auditor is telling that I was not the auditor for the prior. So what are the three things that the incoming auditor is telling? There are three things, and note that. Number one, the fact that the previous audit was done by another auditor. Number two, the type of report that has been issued by the previous auditor. And number three, the date of the report of the previous auditor. So three things, or three statements, or three sub-statements within that big statement within the audit report needs to be given as an other matter. And that would be, I'm going to repeat that. Number one, the fact that the prior audit was done by another auditor. Number two, the type of opinion issued by the previous auditor. And number three, the date of the report of the previous predecessor auditor. Procedures as for continuing auditors would be same in case of comparative financial statements, unaudited comparatives, ensure that there is clear disclosure that the comparatives are unaudited, and other matter paragraph would be given in the auditor's report. The same situation would happen if it was corresponding figures or comparative financial statements, you would be giving similar other matter paragraph. And should carry out procedures as for continuing auditors as far as possible. So before we move on, are there any questions on IC 510 and 710? There should be some. Yeah?
There are some questions. But before we move on, there's a question from last session pending. Can you please explain about indirect assistance and what is the difference between direct and indirect assistance? That is from Zishan.
IC 610 does not use the word indirect assistance. It uses the phrase using direct assistance from the internal auditor. The only other version could be considering the work of internal auditor. So that is where you are not obtaining any assistance from the internal auditor. Rather, you're just reading the reports and figuring out whether there is an impact on the strategy or the audit plan. So that is like more of considering the work of internal auditor, whereas using the work of internal auditor implies obtaining direct assistance from the internal auditor.
Okay, there's another question from Zishan. Why to use management expert? Why is it required? Who is not that much reliable on other parts of audited expert, and is there to assess the work?
Well, yes, of course, in any given situation, it would be better to have an auditor's expert as compared to the management's expert as far as the reliance is concerned. However, there are also cost constraints that need to be taken into account. So, for example, if there is an actuary that has been taken by the management, and that actuary is a well-qualified, well-known actuary, why spend another amount of money on another actuary who is also going to give perhaps the same type of report? So only if the concern is too high, the risk is too high, there is too much of a concern on the part of the auditor, would the auditor want to involve their own expert. Otherwise, from a cost point of view and also from a time management point of view, because of course an audit is a project, and from a project management point of view, you want to complete the audit on time. So it's always better that you have one expert who does the work and management is relying on that, and so is the auditor. So that is usually the better situation to have. However, if the risk is too high, well, the auditor can use their own expert.
Okay, how will the comparative and corresponding figures be tested in the examination?
We'll just look at that. If you just give me 10 more minutes and we'll look at a question that is going to describe that. It's usually a 4 or 5 mark question, not a very long, detailed question.
Okay, here's another question. Please, can you repeat ISA 510?
Okay, just the difference between 510 and 710. 710 relates to how the figures have been presented and what are the responsibilities with regard to the auditor on corresponding figures and comparative financial statements. 510 deals with a very specific situation, and that specific situation is either one, the audit is being done for the first time. So the company was, let's say, a partnership or a sole proprietorship in the past, and is being now audited for the first time. So initial engagement, opening balances. Or two, this audit is being done by this firm for the first time. Previously also audits were being done, but they were being done by some other audit firms. So ISA 510 would relate to opening balances on initial engagement and what the work is or the requirements are with regard to the incoming auditor. And that does not cover a lot of detail on reporting. However, on the audit report section, you would see that the ISA 710 comes into play, where the corresponding figures and comparatives are mentioned, and when we talk just a bit about the slides which you can see in front of you, about what are the types of opinion and what are the other matter paragraphs that need to be described in the report. So, well, as you could see that 500 series of standard relates to audit evidence, and 700 series usually relates to audit reports. So this has more of a reporting flavor, and ISA 510 has more of an evidence flavor. What work needs to be done on opening balances, which I explained that you have to look at the prior year auditors or working paper files, or you have to perform some standard procedures on the opening balances.
There's a logistical question, and I'm sure people will benefit. This is from Amna. We have been recommending to use a black ballpoint. Is it all right to use a black pointer rather than the ballpoint?
I think
logistical question.
ACCA would be the better ones to answer this. I think using anything that is like a permanent ink is always recommended. So anything that can, due to perhaps water or air or whatever, pollution can get washed away is something that would not be recommended. So anything that is permanent and it is there, it does not spread out, is recommended. What is key here is not, what kind of ballpoint or pen you're using, which brand or anything. Actually, it's about, how well you're presenting the answer. So that should be the key focus. So I think usual ballpoint, which I cannot find right now, so I would have shown it to you, a ballpoint pen should work.
And also, I think because these exams are scanned for the markers, so something that can come up nicely on the scan.
Yes, exactly. So sometimes what water-based ink may not appear properly on the scan, so it may not be. And sometimes anything that is written on the back side of the paper will actually come up in the scan. Sometimes it's so hard. So I think it's always better to keep it neat, keep it clear. Do not do a lot of cutting on the paper, and make use of as much space as you have, and keep it open, and leave lots of space in between. Those are some of the key messages that we also discussed in the first session, but I think these will continue to come up. Keep it clean, keep it neat and clean, make it look like a professional answer that has been given.
Burhan is asking, if the prior year contains misstatement, what should the auditor do?
We talked about that on that slide. If I could just go to that slide. Just bear with me. Let me just go there. Yeah, so you can see there on slide 63 that if unresolved prior year problem is material to the current year. So there is a problem, and I gave that example on the inventory weighted average being incorrectly calculated. So if the unresolved prior year problem is still there and it is material to the current year, then you will modify your report for 2016 due to opening balances and comparatives. So you will modify the report.
Okay. Many questions. Do you have
you just take one more question.
Okay. Is the opinion, can the opinion be a disclaimer in the opening balances case?
Well, what kind of opinion should be given in what circumstances, that is usually the topic that we cover in the reports. But however, yes, but very rarely. This can happen that an audit client comes to you for the first time perhaps they have never been audited in the past. And the opening balances are so significant, and despite trying your best, you have been unable to verify those opening balances. And the impact of those opening balances on the balances of the closing balances of the period that you were doing, or on the items that have been recorded in the P&L for this year, is so significant and so huge, and you are unable to obtain sufficient appropriate audit evidence, that in that particular circumstance, it is likely that you will not be able to give assurance, obtain assurance, and then give that assurance, provide that assurance to shareholders that the closing balances are true and fair. And in that case, perhaps a disclaimer would be given, but this would be very clear. All right, we shall now move on to our next topic, which is an important one and relates to other information. Another 700 series of standards. It is IEC 720. This is also a revised standard, as I mentioned, and it has impact on the auditing profession as well. The reason for this, so I'm going to write R over here because it is a new standard. A revised standard actually is the right word to use. Now, what does it relate to? Other information is any information contained in the document that contains the audited financial statements. So the book or the booklet or the binding that you get to see, which is the annual report, that's how it is usually mentioned. There sometimes could be other words that could be used, but the most common used word is annual report, which contains these financial statements. Contains a lot whole of other things in addition to the financial statements. So I just write that over here. The financial statements plus the audit report. Now, in addition to the financial statements and audit report, what else is included? And that is what IEC 720 deals with. All of those things are known as other information. Now, what could this other information be? This other information could be general company information, prior years analysis, outlook on the future, what is the future plan of the entity, some rewards that have been given to the entity. For example, they may have won some recognition, some reward, some key events that took place, some plantation campaigns, some environmental and social initiatives that have been undertaken. There would be some graphical data as well, lots of pictures usually as well these days in the annual report. So graphical representation, graphs, bar charts, pie charts, trends, future trends, industry outlook as well. Also some information with regard to corporate governance. Would also be included within the other information. There could be some specific shareholder information. So how many shareholders are there? Institutions, banks, non-banking financial institutions, individual investors, groups of investors, how many are there? There's also the AGM notice, usually if it's a listed company, so they're going to do the AGM, and the annual general meeting notice would also be there. A proxy form may also be there, so if somebody is a proxy, wants to act as a proxy. So all of this information that you see here in black, in addition to what you see here in red, the financials and the audit report, all of this information is basically the other information. Now, why was this standard required? Why was this standard made? The need for this standard arose because as an auditor, you are issuing this one piece of paper. So in a 70-page document, let's say, in a 70-page document, the only one page that you are going to give is this one page, audit report. What's the risk with regard to this situation? This one page that you are giving relates to, well, perhaps those 30 pages that are the financial statements. But this one page does not relate to all of this other information. So as a shareholder, there's a possibility that any person, or the shareholder or any person who's reading the report may believe or may perceive that this one page relates to not only the 30 pages of the financial statements, but also everything else that is within that book. And of course, it is understood and well understood, of course, that this audit report does not relate to the other information. But we understand this because we are, well, chartered certified accountants, members of the ACCA or affiliates or to be affiliates. However, the general public may not perceive it as such. So this is why the need for this standard arose, that what are the auditor's responsibilities with regard to the other information. Number one, let's be clear. The auditor is not required to audit the other information. We cannot, because it is not in our scope. So we will not audit the other information. However, there are two things that we need to look at. And those are known as a material misstatement of fact or an inconsistency. And that is what you see on the slide in front of you. So you have to identify whether there is any inconsistency between the financial statements and the other information. So for example, this financial statement says the revenue is 100. And this company information or one of the graph says that revenue is 120. So you have 120 on a graph and you have 100 which you actually audited. So this is the audited number. But whenever a shareholder or any person who's reading the report reads this 100 here and then reads the audit report and then reads the graph which says 120, is obviously going to scratch their head and say, what kind of audit was done? Which figure is the right figure? I don't even know. What is this company doing? Who are the auditors? So to avoid that situation, of course, it's important now that the auditor has some responsibilities with regard to the other information in the document that contain the financial statements and the audit report. So what is the difference between an inconsistency and a misstatement of fact? What I just described is an example of an inconsistency. An inconsistency is something that is in the financial statements and also in the other information, but does not match. So it is not congruent, it is not similar, it does not match with each other. So an inconsistency would be arising where, for example, the financial statements say that revenue is 100 and the graph says in the other information that the revenue is 120. So this is an example of an inconsistency. Whereas a misstatement of fact is something that is not over here. It is not in the financial statements. It's not there. But it is in the other information. However, that information is factually incorrect. Now, what does the auditor do in such a case? Obviously, the auditor's responsibilities would be different in case of an inconsistency as compared with his audit responsibilities in case of misstatement of fact. The reason for this is that something that is in the financials as well as in the other information, and one of them is obviously going to be correct and the other is not, is going to raise doubts over the credentials and the credibility of the auditor and the audit report that has been issued. However, if there is a misstatement of fact over here, it will just call into question the competence or of the overall, people preparing that document that contained all of this information, and it may put into question the credibility or undermine, for example, the credibility of the auditor or the audit report. So it is for this reason that IEC 720 comes into play, and the auditor is required to report differently and perform certain procedures with regard to other information so as to make sure that there is no either inconsistency, material inconsistency, or material misstatement of fact in the other information. Now, there are some examples, as you can see on the slide 65. The financial summaries or highlights are also examples of other information. Employment data, a report by management or director on the operations. Sometimes, usually, there is a lot of pictures over there with the directors being really happy and saying, "We're very happy, pleased to say that the company performed really well in this year, and the future outlook is bright," and this and that. And what are the key operations? The factory was operating. There was no idle time, and we were operating at full capacity. The outlook looks really nice. The government is supporting us. We paid all our taxes, and all those statements. Planned capital expenditure, what they want to do in the future. financial ratios. Of course, there will be lots of ratios and graphs and trends, and you may have seen that in many of the annual reports that you get to see on the internet. Names of officers or directors of the employees and selected quarterly, semi-annual or biannual data. The auditor must always ensure that the other information does not contain a misstatement of fact and an inconsistency with the audited financial statements. So on discovering a material inconsistency, let's say that the auditor discovers this material inconsistency, and that is that the financial statements show revenue of 100, whereas the other information shows revenue of 120. So the auditor should determine whether the audited financial statements or other information needs to be revised. Obviously, in this circumstance, one of the two has to be correct and the other is incorrect. So the auditor is going to determine which is the correct figure. So there are two possibilities. One is that the financial statements have the correct figure and the other information is incorrect. And the other is that the other information has the correct figure and the financial statements which were audited were incorrect, perhaps because some information was not provided to the auditor. So the response would be different in case of the auditor having this other information. Do we have a question?
Yes, there's a similar question from 3 different students. It's about misstatement of facts. Can you just explain it, giving an example?
Sure. A misstatement of fact would be something that is not in the financial statements, but it is just there in the other information, but is incorrect. A very simple example of this is the company address is written incorrectly. Now, this does not impact the audit opinion. This does not impact the financial statements, but it is factually incorrect. Right? So, that would be a misstatement of fact. But now, talking about material misstatement of fact, whether a misstatement of fact is so significant that it would cause, some kind of turbulence, as they say, into the judgment of the reader or the shareholder. So that could be something more significant and not just the address being wrong. For example, that in the corporate governance, it is mentioned that the company won an award for best governed corporate governance company of the country. And the fact are that there was no such award. Now this is a material misstatement of fact. Why? Because the company is saying that we won an award because we have really good governance, whereas actually there was nothing that was given to the company. Now this does not have a bearing on the financials. Why? Because the award is not recognized in the financials and it has no impact on the audit. So this is a material misstatement of fact. And this has to be looked at by the auditor, that whether this is an inconsistency that is having the item in both the cases but there being a difference, or it is a misstatement of fact. If a material misstatement of fact is discovered in the other information, the auditor should discuss this with management. Of course, the auditor cannot force the management to change the other information. If there is a problem in the financials, of course the auditor can withhold his report. The auditor can say, no, I want to, you can say that I want to have the correct version with me. I want to make sure that my audit report that I am giving is on the correct figure. He can ask management to adjust the number in the financial statements, have an adjustment recorded in the financials. He can do all that. But if the problem lies here, the auditor cannot actually force the management to change the other information. So now in the new audit report, in the IC 700, there is a requirement, and that applies, of course, only to listed companies. And that is that the auditor has to give a separate paragraph with regard to other information. And they have to say that they have read the other information and they did not find any particular inconsistency. Or if they did, they would have to identify that they would have to state that we identified the following material inconsistency. Now again, this is something new. So I would just like to emphasize this. What you see on the screen, the last bullet, is something that is new. And there is a possibility that it may come up because it is new. So for all listed companies, in the new audit report, there is a requirement that the auditor has to specifically input a paragraph stating that they have read the other information and they either did not identify any material inconsistencies, or if they did, then listing all the material inconsistencies that they identified. Now this is a part of reporting and it is mandatory as per the new IC 700 and 720 with regard to listed companies only. Alright, so we are done with the 700 series of standards, and now we will quickly move on to two other areas which are also tested frequently. before we move towards question practice. Subsequent events, ISA 560. You're well aware of the fact that there is also a financial reporting standard that relates to subsequent events, and that is IAS 1010. And that relates to two types of events that discusses the adjusting event and the non-adjusting event. So the adjusting event and the non-adjusting event, and what is done with each of these. And I also give an example of each. An adjusting event is obviously going to be adjusted in the financial statements, whereas a non-adjusting event is only going to be disclosed in the financial statements if it is significant. Example of an adjusting event: facts and circumstances existed at the balance sheet date or the statement of financial position date. So, for example, there was a trade receivable party that was undergoing financial difficulty, but by 31st December, well, they were not paying you the money, and you knew that there was financial difficulty, but you still believed that somehow you will be able to recover the money. Prior to signing the audit report and prior to finalizing the financial statements, you realized and it came to your knowledge that the company has filed for bankruptcy and it's not going to wind up its operations, and there is next to none chance of recovering any money. So this is an adjusting event. Why? Because the circumstances existed at the balance sheet date. You knew at the balance sheet date or the statement of reporting date that this party was facing financial difficulty, and hence it will be treated as an adjusting event. Non-adjusting event is, for example, a fire or a flood or an earthquake destroying the premises of the entity or one of the godowns or storage houses of the entity, resulting in loss of inventory or, for example, loss of certain fixed assets. Now, this is something regarding which the circumstances or events did not exist at the reporting date, and this happened subsequently. So this will not require a prior adjustment, but will rather only be disclosed in the statement of financial position. Just a bit on the IAS 10, so as to make sure that we cover ISA 560 appropriately. Now moving on to the slides. On ISA 560, so there are two timelines that are available. One is before the audit report date, and the other is after the audit report date. So if the event happens before the audit report date, the things that the auditor is required to do would be different, and if it happens after the audit report date, obviously it would be different. If the events or circumstances, whether adjusting or non-adjusting, take place before the audit report date, of course the auditor would then require management and request them to adjust the financial statements or disclose the facts in the financial statements and then change his opinion accordingly. And if that is done, he will be fine with it. But if it is not, and the item is material and has not been adjusted or disclosed as appropriate or as relevant, the auditor would of course issue a modified audit opinion. However, if you have hit already the arrow with your bow and the audit report date has lapsed, you have signed the audit report, and then an event happens or it comes to your knowledge, of course, then you will have to take, well, number one, legal advice as regards what you can do. Perhaps in certain jurisdictions you may want to address it in the AGM so that all the shareholders who are attending the annual general meeting, the AGM, they are made aware of the fact that this event happened and it could have had an impact on my audit report. However, my audit report date was earlier than this event, and hence my report does not include the impact, and neither do the financials include the impact of this event. And it could be brought to the attention of the shareholders in the AGM. Otherwise, it could also be an option, and it is done in many countries, that you give a public notice, and you do that through a lawyer, so you seek legal opinion on that, and you tell them, the public at large, and of course the shareholder body is also included in that, that this event took place after the audit report date, after I signed the audit report. So that is what is covered in that slide. So if the event happens, as you can see in the slide, prior to the audit report being signed, the auditor shall perform procedures designed to obtain sufficient appropriate audit evidence that subsequent events requiring investment or disclosure in the financials have been identified. And these may include inquiries of management, reading minutes of meetings, and reviewing most recent financial information. These are usually the tasks that you are doing as part of the audit as well. And of course, you are keeping yourself abreast of the changes in the entity, in the industry, in the overall environment within the country or a jurisdiction within which the entity is operating. If it happens after the auditor's report, but before the financials are issued, so this is like that small time period within which the audit report has been signed, but the financials have not been issued to public. So it is not yet public. So it is like something that you can take back. Perhaps the financials and the audit report are with the printer, and the printer is printing them, or the publishing house, they are just compiling the information. So the auditor does not have any obligation to perform procedures or make inquiries regarding the financials after the date of the report. This is what is also known as the passive duty time period. So anything that happens before the audit report date will fall under the active duty time period, and anything that happens after the audit report date will fall under the passive duty time period. The difference between the two is that in the active duty time period, the auditor is on the lookout for any subsequent events, whereas after the audit report date, the auditor is actually not required to specifically look for subsequent events. However, if subsequent events are brought to his knowledge, his or her knowledge, only then the auditor would be required to perform certain procedures. So if a material subsequent event becomes known, the auditor should discuss the matter with management and, where appropriate, those charged with governance. Secondly, determine whether the finances need amendment, and if so, inquire how management intends to address the matter in the financial statements. And if appropriate, the auditor should extend the procedures and issue a new auditor's report. Sometimes the impact may be so huge that you want to adjust the financials and also adjust or revise the audit report. After the audit report signed, but after financials are issued, so everything has been done now, and then the event happens. Even the publishing house has released the financials they've gone to the shareholders. Now they are midway somewhere in the email, in the mail or post box, or perhaps in the hands of the shareholders already, and now the event has happened. So what do you do now? The auditor has no obligation to perform procedures or make inquiries regarding financial statements after they have been issued. When management revises the financials, the auditor shall carry out necessary audit procedures, review steps taken by management to ensure anyone in receipt of the previously issued financials is informed, and extend the audit procedures to the date of the new auditor's report, and also lastly, issue a new report on the revised financial statements, somewhat similar to what we just covered in the previous slide. The amended auditor's report would, however, contain an episode matter, actually would contain an other matter paragraph stating that the previous report was issued at that date and was withdrawn, and this new report is being issued because of the occurrence of the subsequent event. All right, any questions before we move on to actual question practice?
Many questions.
Okay, we'll take 3 questions.
3 questions. Okay, let's take the last one. Can we issue the other audit report while cancelling or withdrawing previous audit reports?
Yes, because both the reports would be dated differently. So you will be having this other matter paragraph whereby you will be withdrawing the previous audit report and stating the facts that why you are in need of issuing this new audit report. So you will mention that in the new audit report and then sign and issue the new audit report.
Varga has asked this question like many times. Misappropriation and misstatement, are these the same things?
No, not necessarily. Misappropriation is more like an intentional irregularity or misstatement that has occurred, and we discussed that as part of fraud when we did IEC 240. So misappropriation of assets would be, embezzling company funds, for example, making fake companies and making payments to them. Using the company funds. So that would be misappropriation, and that is usually obviously deliberate. Misstatement is either could be intentional or unintentional. So misstatement is broader, and that would include intentional misstatements as well as otherwise the unintentional misstatements. Also, errors with regard to classification would also be classified as misstatements. So misclassification would also be classified as misstatements.
Third and the last question. What if an unlisted company has other information to be presented along with the financial statement, and there is an inconsistency in other information? Is there an audit report implication as per the new audit report format?
Yes, that's what we just discussed. So if there is an inconsistency between other information and the financial statements, in the listed company case, The auditor, as per the new audit report format, ISA 720 revised and ISA 700 revised, is required to state what the inconsistency is. So the auditor will, in the report, put a heading of other information and then state that he or she has read the other information and found the following inconsistencies and would list down those inconsistencies. Alright, so let's move on now to December 2011. So you will have to go into the bottom right corner where you have the handouts and you select December 2011, question number 5. So they would just be doing part B of this. So I just want to save some time on the one hand and also just to cover the area that we just did, and let's not have certain areas which we are yet to cover. So we can come back to part A later. So let's just do part B over here. So I am going to give you 7 minutes because this is just worth 6 marks. So 7 minutes to read and make an answer plan for December 11, question 5, part B only. 7 minutes and your time starts now, and then we'll discuss. questions on. All right, time is up. So you had three marked questions. There were two of them. First, related to written representations, a topic, of course, that we did not do. And the other one was something that we just covered briefly a few minutes ago. So if you look at the marking scheme, and for this purpose, you will have to go to page number 29 of the marking scheme. So I would request you to open the answer and go to page number 29. So to get the 3 marks in this question for the, let's discuss B2 first. There was generally 1 mark per point. And generally auditors do not refer to third parties in the report, which is something that is, a rule also stated in the standard. But it is optional to refer to the predecessor auditor unless prohibited by laws and regulations. So if the laws and regulations do not allow you to do that, of course, then you will not. But then if it's not prohibited, you would want to mention. If the reference is made, it should be done to an other matter paragraph, as we just discussed that you do an other matter paragraph in the report. And you describe the contents of the reference made to the predecessor auditor, and that is exactly the 3 things that we talked about a few minutes ago. That was the fact that this was done by another auditor. Number 2, the type of opinion that was issued by the predecessor auditor. And number 3, the date of the audit report of the predecessor auditor. And if the prior year is modified, this will have to be explained in other matter paragraph, assuming that it does not have an impact on the current year. However, if you change the question requirement a bit to say that there was an error in the prior year, and it continues to be an error in this year as well, then of course that would have different repercussions, and the audit report for the current year would be modified with regard to the opening balances contained there. Moving to the first part, which was on the written representations. The date report is when you date the audit report. So you date the audit report when all necessary evidence has been received, including the written representations. So the date that you have sufficient appropriate audit evidence is the date earlier than which you cannot sign the audit report. So it has to be on that day or after, but cannot be earlier than the date that you have all sufficient appropriate audit evidence. Now, in this particular situation, you had done everything in the audit, and everything had actually been done, except for having that letter of representation in your hand, and you had not received that letter of representation. So what would you do in this situation? Consider this as a practical situation. It could happen to anyone working in the audit firm. So, as per the requirement of the standards, you date your report when all necessary evidence has been received, including the written representation, because that is an essential part of the sufficient appropriate audit evidence. It is especially important with regard to subsequent events. So there could have been an event that may have taken place, regarding which you are not obtaining any representation in this situation. So contrary to IC 700, to sign report prior to receiving the written representation. So this is something, it's a situation that will not be accepted. Practically what would happen in this case is sometimes they say that, okay, I'll sign the accounts and I'll leave, maybe the department is going on a holiday, but you do not release the audit report and accounts, and they're not publicized or released per se, unless you actually have all the evidence present with you. So this could also be a situation, the slight change, if I would want to do that in this, is that it is actually the audit partner who's going on holiday, and obviously they are waiting for the representation. Now, he could sign it, but you could keep it with you as an audit manager, but you would not release it unless you have actually received the evidence. So at a firm level, the report is with you, but it's just placed with you because the partner is going on leave. But it is not signed, it is not released, sorry, it is signed but not released unless you get that piece of evidence that you need. So these are the type of questions that would usually come up with regard to opening balances, comparatives, and subsequent events. They would be usually 3-4 marks and not more than that. There have been rare situations where they would be tested for, let's say, 6 marks, maybe 7, but usually 3-4 is the usual number of marks for which this is tested. We'll come back to some other questions as well, but before that we need to cover a few more standards, and hence we will now move to another, let's call this a favorite sometimes, because many candidates I talk to tend to be very enthusiastic about standard. ISA 570, which pertains to going concern. And as you can see on the screen in front of you, the theory around it is, of course, there are indicators that create doubt over the entity's ability to continue as going concern, and you should be aware of that. There can be operational indicators, financial indicators, and other indicators. Now, under the going concern assumption, what is the assumption? The assumption is that an entity is viewed as continuing in business for the foreseeable future. General purpose financial statements are prepared on a going concern basis. So you're assuming that the assets, the liabilities would be settled, and the assets would realize their value in the normal course of business, and that would take whatever the nature of the business is accordingly that number of years. Now, the normal course of business is different for different businesses. So, for example, an oil sector in a company that has an oil rig, the normal course of business for them may be perhaps 20 years. However, in the consumer product sector, let's say that there is a company that is actually engaged in the business of selling chips, potato chips. Perhaps the usual course of business and the normal course of business and the outline for them of business plan they're looking at perhaps could be limited to 5 years. And take that one step further and think about the real estate sector. In the real estate sector, the same kind of outlook on the business, well, it could reach even beyond 25 years. And there are entities over here that we know, working in many countries, in the MENASA region especially, where the outlook that they have with regard to building and constructing different plazas and hotels and hospitality, for example, industry, is actually 40 and 50 years. Because they're looking to develop a whole city, they're looking to develop a whole tourism market, and they're looking at a whole lot of things that need to be developed, and that is going to take a considerable amount of time. So this time span can be different for different entities. However, when you talk about going concern, we technically talk about at least a 12-month period, that is to say 1 year. Exception is there if management either intends to liquidate the entity or cease operations or has no realistic alternative but to do so. The auditor's responsibilities with regard to going concern now. What is the auditor supposed to do? So we've done the theory about what a going concern assumption is, and I'm assuming that, of course, you know the indicators that an entity may not be in going concern, the financial and the operational and the other indicators, which include things like poor financial performance, working capital problems, persistent losses, people leaving the organization, industry, being in significant recession, and so on and so forth. To obtain sufficient appropriate audit evidence about the appropriateness of management's use of the going concern assumption, and to conclude whether there is a material uncertainty about the entity's ability to continue as a going concern. Now, since this is a judgmental area, it is very difficult to say that going concern assumption, on the one hand, it would be easy to say is valid. Well, profitable business, history of operations, well financed by the oil entity, no problems at all, no history, viable business outlook for the future. Another situation would be that definitely the entity is not a going concern, and that is where and the entity agrees that they are going to wind up operations. This could be the case, for example, where an entity is formed for a particular purpose, and that purpose has been achieved. Let's say that an entity is formed with a view to help people who were struck by an earthquake. And now all the donations have come into the entity, and that entity has now passed on all the donations. Everything is done. People are settled. The amount that had been given to the entity has been spent, and the purpose has been achieved, and it's all gone now. So the entity is no longer a going concern. So if it has any assets that are left, for example, maybe some articles of furniture or vehicles, so you put that on the breakup basis in the financial statements. But then there can be a situation which could be somewhere in between these two. And it is this situation which is known as the material uncertainty situation. So, as an auditor, you cannot say that the company will continue for the foreseeable future. But you cannot also say that the company is going to die. It's going to be dead in 12 months. So you are somewhere in between these two situations. So that is the concept of material uncertainty with regard to the going concern assumption. Now, how is the auditor supposed to address this? So there are, of course, the three stages of the audit. First is the risk assessment or the planning stage. That is where the auditor is actually identifying areas which create doubt over the entity's ability to continue as going concern. Then is the second, the execution stage, That's where the auditor is performing certain procedures to ensure that, well, if there are any doubts, how those doubts could be removed, and whether or not there is a material uncertainty. And then third is the conclusion and reporting stage, where the auditor is deciding what kind of report should be issued with regard to the going concern problem of the entity. So on risk assessment, as you can see on the slide, the auditor should consider whether there are events or conditions that may cause significant doubt in the entity's ability to continue as a going concern. If the management has performed a preliminary assessment of the entity's ability to continue as a going concern, the auditor should discuss it with the management. Of course, the first point of contact would be the management, and you would want to do a discussion with them. You want to inquire what are their future plans, how do they assess the situation, how do they evaluate it, and what is the future outlook of the entity. Of course, you would also want to obtain the future business plan of the entity to make sure that there is a business plan, a viable one, and you want to challenge the key assumptions around going concern. The auditor should remain alert throughout the audit for any factors which would indicate problems. But then moving on to the other audit procedures that would be done, which you can see on the bottom of the screen, performed when events or conditions have been identified that may cast significant doubt on the entity's ability to continue as a going concern. And the auditor should obtain sufficient appropriate audit evidence to determine whether or not a material uncertainty exists. So what the auditor is trying to do is trying to dispel whether there is an uncertainty. So they're trying to dispel the uncertainties, the doubts around going concern. You would want to be in either this situation or that situation, because those are the clear situations. Clearly, there appears to be no significant problem. Or clearly, you know that the entity and the management agrees that the entity is not a going concern. However, there can be situations, and it has happened many times in many situations in the past, in many audits, in many countries of the world, that you cannot end up at either here or there. Rather, you're falling somewhere in between. And you are uncertain about whether this is a going concern or is not a going concern. So the additional procedures that need to be done in this case is analysis and discussion of the cash flow, profit, and other forecast. Look at the interim financial statements, review them, and have a meeting with the management, inquire about what the future plans are, as we just discussed. Read the minutes of the shareholder meetings to make sure what are the plans. They may be considering changing the line of business, adding new products to the existing line of business, maybe diversifying operations, buying another company, spinning off a certain part of the business, selling some of the assets so as to be able to generate some cash to finance the operations. Make inquiries with lawyers regarding legal claims. Sometimes it is a huge legal claim that can lead to going concern issues, so you look at that. And reading terms of debentures and loan agreements with regard to any financial covenants that may have been breached. Now, as a result of all of these procedures, if you believe as an auditor that the disclosure is inadequate, so if there is inadequate disclosure in the financial statements, the auditor will express a qualified or adverse opinion. And if there are multiple material uncertainties that are significant to the financials as a whole, the auditor may consider it appropriate to express a disclaimer of opinion. This is an extreme case, an extreme situation where you cannot even have the enough amount of evidence to dispel the myth or fact that there is an uncertainty. You are unable to comment on anything. So there are multiple material uncertainties, and they are so significant that saying that it is a going concern is highly risky. Saying that it is not a going concern is also going to lead to a lot of audit risk. And then saying that there is uncertainty is also something that could put you into jeopardy, because there could be a chance of litigation against you. So you may want to put in a disclaimer opinion in that particular case. However, in the clear scenario where inadequate disclosure has been made, the auditor will express a qualified or an adverse opinion, whereby you know that the entity is not a going concern, but the finances have been prepared on a going concern basis. And that's where the qualified or adverse opinion comes in. Right? So that's the area with regard to going concern. Now, another standard that is important and frequently tested, and we'll cover that quickly as well, is ISA 540.
We have time for one or two quick questions.
Sure, we can take 2 questions.
2 questions. Okay.
Yes.
Can you give an example on how going concern could be examined with prospective financial information?
Yes. There have been instances where question 2 in section A has related to a situation where there is a scenario, there is some financial information and some non-financial information, some English text written in the question. First part relates to identifying factors that create doubt over the entity's ability to continue as a going concern. Then there is a small forecast that is given, and then procedures have been asked with regard to what procedures should be carried out in that circumstances. And that procedures include, obviously, as I said earlier, challenging management's assumptions, challenging the key numbers that are there. So you will have to extract the information out of the whole data that's given, and then you will have to convert that into proper analysis as to what kind of procedures can actually be done. I'll just give a short example, small example. Let's say that the cash flow forecast has been given to you in the paper, and it says that opening cash is 100, and management expects that cash receipts of 500 will be made. So you will receive $500 cash in the first month. Now you challenge that. So what you say is that, how many sales did you make in the prior month? Are they actually all going to realize into cash? What happened in the previous year, or the previous month, or the previous month of the same month of the previous year? And you analyze that. Is the industry expected to grow by the amount that you stated? Which customers did you make the sales to? And are those customers actually paying you on time? So you challenge the 500 receipt that is being shown as a cash in the information that's given. So that's how you basically test the areas that are given.
Okay, last question. And I think it's going to help many others as well. How the issue of going concern is treated when it occurs after the audit report signed off, but before presented to the shareholders.
Okay, so this is basically combining going concern with subsequent events. Well, that's interesting. Hasn't happened many times in the P7 paper. However, it could, yes, happen. So the situation is that the entity appears to be really fine, no problems, and you sign the audit report, no going concern issues. All of a sudden, you come to know that a significant issue has happened, and the entity has now, there is serious doubts whether the entity will continue as going concern. Now, what is the course of action you should take? It's very similar to what we discussed in ISA 560 some moments ago. That whenever the audit report has been signed and a material misstatement has been discovered, or a material adjusting event has been discovered, what do you do? So you have the option if the AGM has not been held. So you can, obviously, you have the right to attend the AGM and speak to the shareholders about it. Of course, you should take legal opinion in the country, in the jurisdiction where you are, so as to say what your rights are. So you find out and you know what the rights are. And then that's how you look at the picture. And the lawyer could perhaps advise you that you may want to give a public notice, you may want to tell the shareholders, send out an actual notice to the shareholders and to the management, the board, that this has happened and I want to either withdraw my opinion and issue a new one, so you should change your accounts. And based on that, you would discuss that with the management as well. So you would want them to, if they are willing, of course, change the financial statements, prepare the accounts on not being a going concern basis, on a breakup basis, and then appropriately issuing a revised audit opinion, in which you would have another matter paragraph stating why you withdrew the previous opinion and are issuing the new opinion. So those are all the options that are available to you. Now, moving to ISA 540, which is on fair value, we will do some quick revision of certain key standards, the financial reporting standards, and some key concepts. So this will be a very quick session in which you will get to go through a lot of slides quickly, just covering some of the accounting areas as well. Before we move on to a question requirement, where we will actually be required to apply the knowledge of the P2, the financial reporting standards, and some of the knowledge that you are just looking at on the screen. Fair value, number one. Do note that fair value is an accounting estimate, and audit of accounting estimates is covered under ISA 540. So previously there was also another standard, ISA 545, which dealt with only fair value estimates, and there was an audit, ISA 540, which dealt with the other estimates. Now you have ISA 540, which deals with accounting estimates, including fair value estimates. So the auditor is required to assess the entity's process for determining accounting estimates. This includes fair value measurements and disclosures and the related control activities. So the auditors, what are they required to do? They should address the risk arising from the material misstatement. And once the auditors have assessed the risk associated with determining fair value, they should design further procedures to address this risk. Now, what does it basically mean? Sometimes fair value, this concept of fair value, sometimes it's really easy to calculate. Why? You have a listed entity. It has a quoted price. And this is your investment in the entity. So you know what the quoted price is. Stock market is active, this is an active market, and you know that this is the price at which it's currently at. However, this is the easier part. Sometimes you can be faced with a situation where, for example, you have an investment in a private company. What do you do here? How do you value it? So there can be different valuation techniques. And that's where the concept of fair value becomes a little tricky. So there are so many different models, and you have covered that in paper P4, or you may be doing that right now as well if you're giving that paper. There are different methods of valuation of companies. So there's the forward growth method, the dividend valuation method, the discounted cash flow method. There could be a similar sized company which is listed for which a price is available. Well, that method could be used. The different valuations could be assigned based on different hypothetical assumptions and models. Value views could be used to work out what is the actual cash flow arising from this investment. If I intend to keep it or not keep it, depending on that. So fair value would get a bit complex in this case. Also, same situation, slightly at a different level, would apply to money market. For example, you have a bond. So you have a money market instrument, and that is something that you want to value. So this is a bond that is going to go on for 10 years or 15 years, 20 years, and it has a certain rate, and the rate right now is going down. So this bond has a premium to it because it is higher value, because it has a higher interest. Now, what should be the value that should be assigned to the bond? Of course, based on the requirements of IAS 39 and soon to be IFRS 9, it would be valued using different valuation techniques that are allowed by the standard. Now, this, of course, as an auditor, from an auditor's perspective, would involve certain complexities, and you may also involve some experts into this as per IAS 620. So, what would be the procedures on fair value? You can see them on the slide. You refer to the market where the fair market value or the fair value equals the market value, and it can be in the case of the quoted price of the listed company, example number 1. You could use the work of an expert. You could consider management's past history of carrying out its stated intention with respect to assets or liabilities. Now, what does this mean? Is that certain investments could be held to maturity. Certain could be held at fair value through P&L. And certain may not be decided at all. So they would fall in the AFS category, available for sale category. And they would be valued as per IAS 39 accordingly. So you look at the management's intention with regard to it. So if the entity has a bond in money market, and that bond the entity intends to hold until the whole tenure of the bond has lapsed, which is, let's say, 10 years. So that is an HTM, an held to maturity instrument, and you value it at amortized cost according to IAS 39. So as an auditor, you would want to know whether the amortized cost has been worked out appropriately. You review the written plans and the documentation, and this would also be effective and important in the case of, let's say, hedge accounting, for example. So the hedge has to be documented, the hedge relationship, including the hedging instrument and the hedged item. And consider management's stated reason for choosing a particular course of action. You also consider management's ability to carry out a particular course of action. Moving on now to inventory and construction contracts. IAS 2. Well, the key premise in IAS 2 is the rule with regard to lower of cost and net realizable value. So you have to realize that what the basic requirement of IAS 2 is. This is something that is frequently tested. Almost, well, I'd say every P7 attempt. But this is so basic that you don't have to get into a lot of nitty-gritties and complex details because it's a fairly simple standard IAS 2. As an auditor, what your concerns are whenever inventory comes into play in paper P7. Your concern is the valuation basis reasonable? And for this, the procedures that you go on to perform are review purchase invoices, consult the price index, and inquire from management. Sometimes you want to look at the subsequent rate at which the subsequent purchases have been made. So for example, I have an inventory item that I purchase and then sell without processing or adding any further value to it. And I was purchasing it for $10 throughout the year. Just after the year, commodity prices went down, and this asset or whatever this product is, the value came down to $7 per unit. So it was 10 and it came down to 7 now. So of course it gives me an indication that the net realizable value of the inventory that I'm holding, which of course I'm doing at $10 because I purchased the whole inventory during the whole year at the standard rate of $10, is not going to actually realize $10. It's in fact going to give me $7. So I bring it down. So sometimes the review of subsequent events can also give an indication with regard to the NRV or net realizable value of the inventory. Is the calculation correct? Well, you check the maths, which is an essential part. You check the arithmetical and clerical accuracy. Consider if the calculation is reasonable with regard to the net realizable value. Sometimes it is the weighted average method that has been applied. Sometimes it is the FIFO method, first in, first out. Some people call it FIFA, perhaps, the FIFO. So the FIFO or the FIFO method or the weighted average method, and the auditor can recalculate that during the maths. Verify two invoices, personal records, nominal expense accounts, and use analytical procedures. The second last bullet that you see, the personnel records or the nominal expense account, relates to situations where absorption costing has been used. So for example, I'm making my labor cost part of the inventory, and that is because the labor cost includes factory workers. So it's the factory worker, let's say there's a bench that's coming and there are products and I'm maybe cutting something and I'm a factory worker. So my salary should actually be charged to the cost of sales because I'm a factory worker and not somebody sitting in the finance department. So in that case, this cost should be made part of the inventory. And that is something that I, as an auditor, would want to see. Whether those costs have been appropriately, accurately calculated, computed, and made part of inventory according to the requirements of IAS. Moving on, I-16, another favorite one as far as P7 is concerned. I-16 relates to property, plant, and equipment. The key concepts, as you know, are two models that are allowed, the cost model and the revaluation model. So, and then there is the concept of depreciation, which is in the case of intangible assets, amortization, and in the case of PPE, property, plant, and equipment, depreciation. Disposals, revaluations, and impairment. What happens with depreciation? What procedures can you do? You can verify that by reperformance or a proof in total check. So this is like basically doing an analytical or a recalculation, a predictive. Sometimes you also call it a global test, predictive test, whereby you recalculate the depreciation based on the asset's value and the life that it has, useful life, or the estimate of the depreciation rate, and you match that calculation that you have done yourself as an auditor with the calculation done by the client. On disposals, you check the authorization on the disposals and whether the proceeds against the disposals, the gain on sale or the loss on sale or disposal that has been calculated, has been done so appropriately. On the revaluations, you verify that the cost can be verified through a valuation certificate, and on impairment, which we also discussed earlier, that an asset is impaired when its carrying amount exceeds its recoverable amount. And you would be sure of the recoverable amount. I'll just mention that here, just so that anybody who has passed P2 a long time ago should remember that the recoverable amount will be the higher of value in use versus fair value less cost to sell. So that is the concept with regard to that. Now what happens here is that the value in use is obviously based on the assumption that you are going to continue to use this asset, and the economic benefits that are going to come primarily through use rather than sale. And hence you use the present value of discounted cash flow method. So you put that all in a table, all the cash flows, the free cash flows that are going to arise out of the usage of the asset, and then you discount them using a discount rate to arrive at the present value, which is the value in use. The fair value could be obviously different from that, because that assumes that what will be the value of this asset if I were to sell it in normal market conditions today, minus or as adjusted by the cost that are required to sell this asset. So this will be compared with the value in use, and whichever is higher will be taken as the recoverable amount. What would be the audit procedures on impairment of assets? I will identify any indicators of impairment. If there are any, of course, I will have to ask management to conduct an analysis of impairment, and that would involve calculating or estimating either the value in use or the fair value less cost to sell. I will review the calculation of the recoverable amount, and assess reasonable of the cash flows used in value and use calculation. Now this is an important point. The third one, as you see on the slide, how do I assess reasonableness of cash flow that is used in value VIU calculation? Again, it relates to what we will cover in some part in the PFI, and also what we did just a few minutes ago in the going concern when you have a cash flow forecast example. So you test whether, and you ask management, what are the key assumptions that are made with regard to this? Of course, it's all related to the future. So if I have, let's say, if I have a plant right now that manufactures juices, and now I'm going to test it for impairment, and I'm using the value in use methodology of IAS 36, what am I going to do? I'm going to say that if I was to use this plant, what is the optimal capacity I would be able to generate? What are the number of packs that I would be able to make? What will be the revenue that I would be able to earn by selling those packs, minus all the selling costs? What will be the cost associated with producing the juice, packing the juice, having the labor ready to do all the packing and all the manual work on the juice, so that it is ready to go to the market? And then what will be the net cash flow that I would receive as a result of using this plant and machinery to manufacture the juice? And this I would do over a fixed timeline. So I would say that, okay, this plant has a life of 5 years, so I will take 5 years cash flow, and then I will discount that now. So as a key assumption that I would be challenged is, how much will I be able to produce? Whether the plant has the capacity to be able to do that. Whether any repair and maintenance cost will have to be incurred during this time of 5 years, and for that purpose the plant may have to be shut down. Whether the costs that I have taken include adjustments for inflation, for example, that would impact my salary increments that I will be giving to the factory workers. Whether the packaging costs for this juice that I have taken are based on reasonable and sound assumptions. So those are the key questions that you will be asking management, and reviewing the analysis and industry information that would be available in order to test the assumptions. So what you see here on the slide is a very small line. It's just one bullet that says, assess reasonableness of cash flows used in the value use calculation. But just this word, assess reasonable of the value use, is actually going to entail a whole lot of things, and there will be many things that you will have to consider. Now, in the P7 paper, how could this come up? Well, it could be any type of company performing any type of services or producing any kind of product. But just as I gave this plant and machinery example to you, this is how you're going to work out applying your knowledge, but not reproducing what is here stated in the slides or in the standard, but rather applying that knowledge to actually come up with procedures and tasks that you would be doing and discussing with management with regard to this area. You will also consider the use as an expert to corroborate the net realizable value and check that any payment losses recognized are correctly written off. So if there is any payment, that has been correctly charged to the profit and loss account. Moving on now to IAS 38. This little difference of area with regard to property, plant, and equipment, of course, is that the intangible asset is intangible and you cannot see it, and hence it's not depreciated but rather amortized. But that is not the only difference. There are certain other areas, additional areas that are included in IAS 38, and that is with regard to, for example, development cost. That is also an area frequently tested in the paper P7. So every 2 years or 3 years, you would get to see a question that has some element of IAS 38 development cost criteria. As you are well aware of the fact that as per IAS 38, development cost can be capitalized if a criteria is met, and that criteria includes these things as you can see on the screen. Number one, the development cost is being incurred for a project that is technically feasible. The intention to complete or sell is there. You actually intend to complete the project, and for which you are incurring the development cost, and then after completion actually selling the product. It is not just general research of the market that you are doing, and that is how research is different from development. Your ability to use or sell that product, the existence of a market for that product. Sometimes you're in the research phase and there is no market because it's a new product that you're making that nobody knows about. And in that case, it would not classify as development, but would rather be treated as research. And research, as you are well aware, would be expensed out and not capitalized. Availability of resources to actually fund that development project, and expenditure can be measured reliably. It should not just be a vague estimate of what is the amount of expenditure. It should be actually measurable, reliable. So those are the 5-6 key things that are the criteria with regard to development cost. As an auditor, these are the key things that you would be testing as well. So we're not discussing a lot of accounting right now. Rather, we're looking at these things with an audit focus. So whenever they come up in the exam, make sure and make it a point that you do not just reproduce what is given in the accounting standards, but rather you actually put an audit flavor to it. So you tell that we will have to ensure that the project for which the development cost is being incurred is technically feasible. And you will do that by obtaining industry analysis and industry reports with regard to that. Figuring out whether a similar product has been developed or is already in the market by some competitors, for instance. What has been the response to that product? Whether there is a market actually for that product. What are the market independent analysts and researchers saying about that product? Those are the type of procedures that you would be mentioning if such a question comes up. Also, some other audit tests with regard to development cost. Check accounting reports, review the market research, and review budgets and forecast, which we just discussed. In other words, ensure that the criteria are met and disclosure is correct. Financial instruments. Now, something that some of the P7 students find really difficult and hard to digest. That's because they found perhaps financial instruments hard to digest in P2 when they passed that. Well, one thing's for sure, that financial instruments at that level of detail which you saw in P2 is not going to be examined in P7. Why? Because P7 is not a financial reporting paper. It is an advanced audit insurance paper. So you basically require to make sure, to be sure that you know the basic requirements of IAS 32, 39, IFRS 7, and the disclosure requirements, of course, with regard to that, and the key risks as an auditor that are faced in the audit of financial assets and financial liabilities. That is to say, financial instruments in general. What are the broad categories within which a financial asset can be recorded, and the categories in which a financial liability can be recorded? And in each of the categories, what is the accounting treatment? With regard to hedge accounting and derivatives, it is not important to know the nitty-gritties and the whole complex details with regard to derivatives. However, you should know that there are based derivatives, have a small initial investment value, they are based on an underlying, and they are complex. So just have a refresher of some of the basic knowledge of P2 that you gained in P2 with regard to financial instruments, but you do not need to get into a whole lot of detail. So for example, if you do not know the Black-Scholes model for option valuation, it probably will not have a significant impact on whether you pass or fail paper P7. Now, financial instruments, the types are held to maturity, loans and receivables, fair value through P&L, which are held for trading, and or available for sale. The investment income is obviously, as an auditor, you're going to ensure recognized only when appropriate. Audit procedures with regard to financial instruments would include procedures with regard to these assertions. Always tend to think of assertions. So whenever you're coming up with audit procedure questions, you should think about the assertions that are being questioned. Sometimes it is just the existence assertion. Sometimes it is the valuation assertion. Usually the most difficult one to audit is the valuation assertion for financial instruments. Talking first about the completeness, occurrence, and measurement assertion, as you can see on the slide, check all income is received and review for any unusual entries. So for example, there is an entity which is like a brokerage house or an investment bank, and there's a huge number of sale and purchase transactions that is being carried out. So you want to know whether the investment rules of the country have been applied and they have been complied with properly. But also you would want to know that any gains or losses that have been made as a result of this quick and humongous amount of sale and purchase of securities and investments has actually been recorded appropriately and accurately within the right heads in the financial statements. Existence of financial instruments. You examine the certificates of title, third-party confirmations. Usually what happens is that whenever you make investments, you do that through a brokerage house or through an investment company or somebody who is usually known as a broker in the stock market. And that person then sends you monthly or quarterly or biannual statements confirming that this is the balance in your account and on your behalf we are holding XYZ securities. So that third-party confirmation can be used by the auditor as well. So the auditor can write directly to the brokerage house or to the broker, and the broker can confirm that yes, I hold XYZ securities on behalf of the company, which is your audit client. Transfer documents could be reviewed and scanned on a sample basis, of course, and the purchase invoices or contracts would actually be reviewed as also the sales invoices. Coming to the valuation assertion, we would refer to the financial press lists, which would be the quoted market prices, if available, for stock market for listed companies. Check for post-year evidence of impairment. Sometimes what happens is that after the year end, there is a significant decline in the value of the investment, and that could be an indicator of impairment. You review the account of unlisted investments, and that would include the net asset valuation, so as to make sure that the NAV or the net asset value is reasonably calculated. And you would check that the base is appropriate as per IAS 2 and 39. It's an important slide, this one that you see. However, do note that none of these procedures that you see on the slide would require to be reproduced in the exam. Rather, you would have to apply this knowledge to the exact scenario in question. There could be a situation whereby you are given some financial information as well with regard to the financial instruments, or maybe some information about subsequent reduction in the value of the financial asset after the reporting date. And that would of course trigger the impairment that we just talked about. So there will have to be instances where you will have to apply this knowledge and not just reproduce the knowledge that you see on the slides in front of you. Any questions so far?
One question.
Let's take a question now.
This is from Nakash. Sir, like in F8, we used to learn audit procedures. So do we have to learn audit procedures for P7 exam as well, like for areas like investment in portfolio or impairment, etc., or do we have to test the facts of scenarios?
Not at all. And so does ACCA, in fact, not just me. They discourage remote learning, and we do not want that to happen because P7, as I said earlier, is an application-based paper. It does not require just the transfer or reproduction of knowledge that is there in the textbooks, right? So it is many notches above the level of F8. Why? Because it is all scenario-based. You will be given lots of information in the question. There will be lots of English text, and there will be a lot of financial information. Numbers would also be there. So you will have to apply your knowledge rather than reproduce something that you see in the textbooks or on the slides in front of you. So never do that, and I highly discourage, strongly discourage that. However, certain cases can arise whereby you are required to refer to the requirements of certain ideas. For example, we just talked about impairment. So if there is a situation in the exam whereby there is an investment and the investment value has decreased after the reporting period, this is an indication of impairment. You will have to refer to the basic requirements of IAS 36, which talk about, let's say if it's IAS 39, which talks about a financial asset impairment, which says that basically if there is an indicator and they are significant or prolonged, then you will have to account for that. So there will be some reference to the requirements of the standard. There will be some reference of the audit procedures. You will not copy-paste the audit procedures from anywhere. Rather, you will apply your mind and apply the knowledge that you have. Some of the words could be common, but not all of them. So you must apply that your knowledge in the actual scenario that is given. We will now move on to income. And on income, the key thing that has happened with regard to paper P2 especially is the advent, let's say, or the birth of the new standard, which is IFRS 15. Now, for those of you who have not studied IFRS 15 in paper P2, they may find it a bit difficult to comment on revenue recognition or related issues within the ambit of revenue recognition. However, it is important, and I strongly encourage, and you just Google it and you will find out. What is the 5-step model? 5-step model for revenue recognition. So one key mistake to avoid is talking about risk and rewards all the time. Because in the previous P7 papers, it has been noticed that many times candidates would write at length about risk and rewards have been transferred or have not been transferred, and this is not only risk. The risk and rewards may not have been transferred and revenue may have been recognized. However, this may not work now that IFRS 15 is in place. So we will talk about the 5-step model. And the 5-step model is basically identify the contract with the customer and who are the parties to the contract and what is the contract about, number one. Secondly, talking about the transaction price. What are the performance obligations, thirdly. and then recognizing revenue where known as the performance obligations are delivered against that transaction price. So it's basically a whole a different way of looking at the things and the way the revenue is being recorded. However, do not get too bogged down or worried about this standard. The reason for this is that, well, number one, it is not a financial reporting paper. And number two, it has already been tested at P2 level. So you are expected to be, well, aware of the basic requirements of IFRS 15 and not the nitty-gritties or the downright, detailed aspects of IFRS 15. However, there could be an industry whereby IFRS 15 comes into play, for example, the telecom or the oil and gas sector, where this could be applied differently. But it is unlikely that it would be examined in a lot of thorough detail at that level for P7. So previously what was found as part of IAS 18 revenue is now the IFRS 15 5-step model, and revenue is often audited by analytical review as it has predictable relationships, and there is generally lots of information available about it. So the key thing that I would like to point out here is that whenever we talk about revenue lending standard, you should mention substantive, analytical procedures. So the key thing on revenue would be your analytics in addition to your controls testing. So if you've done your test of controls, and the controls are operating effectively, usually you can get to the desired level of assurance by performing substantive analytical procedures. And these would include, amongst others, preparing a trend analysis of the revenue month by month and looking at what is the variance about and relating that to the events or circumstances happening within the entity or the industry or the organization in general. Then doing a predictive test on revenue, for example, where number of units sold or the price per unit is homogeneous, is same throughout a long time period of time. So doing a predictive test on revenue. Then comparing the marketing expense, for example, per month, per week, with the revenue, the corresponding revenue that has been coming up. Comparing, for example, in the electricity sector, the number of units that have been dispatched from the powerhouse or power station, and compare that with the revenue that has been earned in the next month, because you bill that next month, let's say. So there could be different situations, and those different situations would guide, again, the application of knowledge. However, I do encourage that you Google the 5-step model, learn about this if you do not already know about it, so that you are well aware of what to write with regard to that. And avoid the tendency to write about risk and reward, because that is now an old concept, and you should not talk about 5-step model, and I just mentioned about performance obligations and whether they're delivered and recognizing the on the contract when or as the performance obligation is satisfied. On the liability side now, deferred tax. Well, deferred tax could either be an asset or a liability, and, well, in both cases, it can be a problem as far as the auditor is concerned. On deferred tax, what you do is that you obtain a copy of the deferred tax working and the tax computation and check the arithmetical accuracy of the deferred tax working. You agree the figures used to calculate timing differences to those of the tax computation and the financial statements, and you consider the assumptions made in the light of your knowledge of the business and any other evidence gathered during the course of the audit to ensure reasonableness. What becomes more problematic is when you have a deferred tax asset. So when you have a deferred tax asset, the requirement of IAS 12 is that you can only recognize a deferred tax asset on losses to the extent that there will be future taxable profits against which the deferred tax asset can be utilized. And that is again where the concept of challenging the key assumptions about the future, looking at reviewing the business plan of the entity, making sure that not accounting but taxable profits will actually flow into the entity in the future comes in. Contingent liabilities. Of course, contingent liabilities as per IAS 37 is something that is not adjusted or recorded in the financials, rather disclosed, and it is something that is the auditor believes is dependent on the occurrence or non-occurrence of a particular event, and it is hence just disclosed if significant. So the auditor has to assess whether disclosure of provision contingent liabilities and contingent assets are correct and sufficient. Now, what does this involve? This would basically involve reviewing the correspondence, and that would include correspondence with, let's say, the tax authorities, the lawyers, discussion with the directors of the entity to know what is their stance with regard to particular litigation matters, for example, referring to comparable past events, and seeking verification from solicitors, of course. So you can write a letter to the lawyer asking them for their expert opinion as regards what is the likely outcome of the case or the chances of winning the case, for example. Recalculating provisions for accuracy and considering the nature of the business. On employee benefits, we talked a bit in detail about this, reviewing the actuary's report, IC 620 using the work of an expert, assess the reasonableness of assumptions, and review the board minutes post the year end. So now we move to the area of group audit before we move on to some question practice. Now, what is different in a group audit as compared to the other audit situations that we usually get to see? In a group audit, what happens is that there is a parent, and then there are subsidiaries. So let's say that there is subsidiary 1 and subsidiary 2. So what happens is that the parent's consolidated finances are being audited by what is known as the Group Engagement Team, GET, and the GET is headed by the Group Engagement Partner, GEP. And Mike will be talking about ISA 600. So in terms of ISA 600, how it replicates is that similar situation comes in, whereby you have the Group Engagement Team under which are working the component audit teams. So you have the component auditor 1 and the component auditor 2. Group engagement team is headed by the group engagement partner, who is the person signing the audit report on the consolidated financial statements. So those are the key concepts that you need to bear in mind. Now this each, subsidiary 1 and 2, in terms of ISA 600, are known as component. So this is component 1 and this is component 2. The component is an entity whose financial information is included in the group financial statements. The group financial statements, of course, are the consolidated financial statements that include the financial information of more than one component. So this is combined. So you combine component 1, component 2, and the standalone financials of the holding company, the parent. So the three entities' finances are combined to make the consolidated financial statements. And you know this from your IFRS 3 studies from paper P2. Component auditors, as I said here, are auditors of the subsidiary. So component auditor 1 is basically the auditor of subsidiary 1 or component 1. And similarly, component auditor 2 is the auditor of subsidiary 2 or component 2. So it's an auditor who, at the request of the group engagement team, performs work on the financial information of the component. So he's going to work on the financial information of the component, not of the parent. So he does not have access properly to the records of the parent, the holding company, but rather is the auditor of the subsidiary. The group engagement team includes partners and staff. So it is headed by the GEP, the group engagement partner, and the whole team is known as the GET, the group engagement team. Partners and staff establish the overall group audit strategy, communicate with the component auditors, and perform work on the consolidation process. Now, the responsibilities of the group engagement partner, the GEP, again, as we talked about in quality control yesterday, a lot of responsibilities rest with the engagement partner for quality. Similarly, in a group audit situation, a lot of responsibilities with regard to the group audit rests on the shoulders of the group engagement partner, because he is the leader of the ship, he is the captain of the ship, and he is the person running the show and signing the audit report on the consolidated financial statements. So the partner is responsible for the group audit engagement and the auditor's report to the group financial statements. He is responsible for direction, supervision, and performance of group audit and opinion on group financials, and he must determine whether sufficient appropriate audit evidence can be obtained in the consolidation process and the financial information of components. So there will be no reference to the component auditors in the report, usually because the reason for this is that the group engagement team has been given full responsibility for giving an opinion on the consolidated financial statements. So they cannot say in their report that subsidiary 2 was audited by component 2, so please go and ask them about it because I don't know anything and I'm just the auditor of the parent. No, that cannot happen. So the group engagement team has the responsibility for the consolidated financial statements being audited. And that includes the results of not just the holding company, but also the other company. Something is happening. Stop sharing the webcam. Is the webcam not being shared? Just bear with me a minute for the technical problem that we have. Just a couple of minutes. Sorry for that. All right. Sorry for that. So there will be no reference to competent auditors in the report. So what would happen here is that the group engagement partner cannot say in his report or her report that I take no responsibility for component 2 because that is being audited by component auditor 2. So this is a relationship whereby it's like a subordinate and boss relationship. So the component auditor 1 and 2 are working as subordinates for the group engagement. So whatever information they are requiring, they will ask the component auditor 1 and 2 to supply that information to them, and based on this and the evidence, they will be able to sign the audit report on the consolidated financial statements. Of course, not all the components will be significant components. So the significant component will get more importance as far as the group engagement team is concerned, and their risks and the adjustments that are arising in their financial statements would be subject to more scrutiny and review at the group engagement team level. The group engagement team must obtain an understanding of whether the competent auditor understands the relevant ethical requirement as it is dependent. And the reason for this is that the independence requirement will not apply on the country or jurisdiction or the subsidiary 1 or the competent 1, but rather, since the competent auditor 1 is working as a subordinate, per se, for the group engagement team, so the ethical and independence requirements that would apply would be the ones that relate to the jurisdiction of the parent, which is being audited by the group engagement team. The competent auditor's professional competence would also be tested, whether or not they are able to deliver the work, do it on time, and do it at the appropriate level of audit quality, and whether the group engagement team will have sufficient involvement in the work of the competent auditor. So whether or not effective communication can be made, or the data that the group engagement team may want to have can be shared, and the competent auditor can share that data, and whether any instructions can be easily passed on. And whether the competent auditor operates in a regulatory environment that actively oversees auditors. This will also help in assessing the work of the competent auditor. Now, what will the engagement teams be communicating? The work to be performed and the use to be made of it. A request to confirm that the competent auditor will cooperate with the group engagement team. Of course, relevant ethical requirements, component materiality. So, who will be communicating the materiality and calculating it? It is the group engagement team that will calculate materiality for the competent and communicate that materiality to the competent auditor and identify significant risks and related parties. Because the knowledge of the significant risk rests with the group engagement team because they have a higher, broader level of understanding of the group as a whole, and with the related parties as well, because they at their level would know more about the related party of the organization as compared to each one of these individual components individually. So this will be shared by the group engagement team with the component team, the component auditors 1 and 2, based on which the component auditors are going to execute their work. Now, all the other aspects of the audit will remain the same as per the normal audit that we just have been thinking about and discussing over the last 2.5 days. However, there will be slight differences with regard to communication, as we just discussed. And the overall responsibility, of course, will rest with the group engagement team, and the head of that will be the group engagement partner. Now, what will be the responsibilities of the component auditor? The component auditor will communicate identification of information reported on. What is he reporting on? He or she. The risk committee misstatements in the group financial statement. What are the key risks or the wrongs as we talked about in the financial statements of the components? Because the component auditor 1 and 2 are only talking about their own components. List of uncorrected misstatements. So as a result of performing all these procedures, what are the uncorrected misstatements? And those will be communicated to the group engagement team. Indicators of management bias, if they believe so, are any at the level of the subsidiary. Indicators of management bias, material weakness in internal control over financial reporting. So for example, there is a significant control weakness. So that will be communicated by the component auditor to the group engagement team. and other significant matters including fraud and suspected fraud, if any, has been discovered or suspected at the subsidiary level, will be communicated to the auditor of the parent, which is the group engagement team. After steps 1 and 2 have been done, step 1 is information going from here to here, and then step 2 is information going from the competent auditor to the group engagement team. Then comes step 3, which is the evaluation of the work. So whatever work has been done by the competent auditor will be evaluated now by the group engagement team. So evaluate communication from the competent auditor, and this would include discuss matters arising with the competent auditor or competent management. Decide whether it is necessary to review the parts of competent auditor's audit documentation. So it is a possibility that the group engagement team may decide that they want to review the file, the audit file of the competent auditor. They may want to visit the premises and have a look at what are the audit findings and what are the procedures that have been performed and whether the work is adequate, sufficient. And if the conclusion is that the competent auditor's work is insufficient, determine additional procedures required. Let's say that there is a scenario where the group engagement team comes, reviews the work of the competent auditor, and they say, we think that you did not perform the required level of procedures at the required level or quality which we wanted you to. Perhaps, and the reason for that is maybe they do not have the right technical knowledge or competence to do it, because they are not well versed with the financial reporting standards of this country. So in this case, you cannot get away as a group engagement partner by saying that, well, it's all dependent on them. No, but you would have to then perform specific procedures on the subsidiary at the level of the head office, at the parent level, to address any risks. And then also there will be at the group engagement team level, the audit of the consolidation process. And this is basically arithmetical accuracy checks and clerical accuracy checks, making sure that the numbers have been tied up, goodwill has been calculated appropriately, share capital has been reversed, any intercompany transactions have been adjusted appropriately, and there is no unrealized profit or loss with regard to the sales that have been made within the group. Treatment of associates in participating in trust, as you are well aware that associates are not gone through the line-by-line method of consolidation, but rather they are put through the equity method of accounting. Treatment of goodwill and intangible assets. Foreign currency translation can be an issue, especially if this subsidiary is US, this subsidiary is British, and this subsidiary is French. And this will probably create problems because you will convert the pounds into the dollars here and the euros into the dollars here, and the consolidated financial statements will be prepared in the US dollar currency. And this will obviously lead to a revaluation reserve being created in the consolidated financial statements. Now, treatment of restrictions on distribution of profits of a subsidiary, and review the consolidated accounts to confirm that they give a true and fair view in the circumstances. Of course, at the overall level, as I just said, it is the responsibility of the group engagement team and headed by the partner to make sure that all of the adjustments with regard to consolidation have been appropriately made and consolidation has been done appropriately. Okay, any questions on consolidation before we move to a bit of question practice?
There are many questions on various topics.
Okay, so we'll take 3 questions from the group auditing subject.
Okay, is the materiality set by group auditor different than materiality of the component?
Yes, it can be different, definitely. That's a good question. If the component auditor is doing a separate statutory audit of the subsidiary, the materiality thresholds that would be applied would be based on the local understanding. However, the materiality that will be communicated by the group engagement team for the audit of the component is likely to be different from that materiality. The reason for this is the way these guys view the risk will be different from the way that the local level, the subsidiary components are viewing the risk.
Okay, another question. What if there are different audit firms auditing for the 2 different components of the group?
Yeah, so
or in different countries.
Yeah, so there can be a different, there can be these cases, and it happens frequently. And in that case, of course, the same requirements of ISO 600, which we also studied in 610 and 620, testing the competence and evaluation of the expert, as you talked about. So now you evaluate the competence and credentials and qualifications of the other auditor. And as I just discussed, if you believe that the competent auditor is not sufficiently qualified or has not performed the required level of procedures according to your satisfaction, then you will have to perform certain additional procedures at the subsidiary level.
Another question, sometimes when a subsidiary is foreign, there may be some issues which may be allowed according to their standards. So how this type of ethical situation can be treated?
It really depends on if that kind of ethical situation or illegal, let's say, activity that has been carried out or any penalty that is being imposed is material at the level of the consolidated financial statements. It can be a possibility that there is a huge penalty that has been imposed on component 1. And for the purpose of the component 1, it is really big and it is going to impact the financial statements. But when you consolidate, because there are 3 entities, there is also component 2, there is also parent, and these are all being combined, so that huge penalty, which was apparently huge at this level, is not that significant, it's not material. So there is a possibility that at the end of the day, this may remain a clean audit opinion, and at the subsidiary level, it would be a qualified audit opinion. So this can happen, yes. Let's take one more question.
One more question is from Sadia, transitional audit.
Transnational audit.
Yes, transnational audit. Can you please explain?
Yeah, there is a slide on that, and okay, I want to do that more, but we can do it right now. So that's the slide, transnational audit. It is basically an audit of financials which are or may be relied upon outside the entity's own jurisdiction. So I am doing an audit based in the US of a company that is based in Canada that is going to use that audit report for the purpose of obtaining loan from a bank that is based in Sweden. Now this is transnational, it's a cross-national audit. I am based in the US, the company is Canadian, and they want to obtain a loan from a Swedish bank. So the Swedish bank is now going to use the report of the Canadian company, but that has to be prepared under Swedish accounting rules and audited as per the US reporting laws. The reason for that is that this Canadian company is also listed on the New York Stock Exchange. So that's transnational audit, and that obviously requires a lot of coordination and cooperation. So this could be for the purpose of significant lending, investment, or regulatory decisions, as you can see on the slide, and includes audits of all financial statements of companies with listed equity or debt, and also includes other public interest entities which attract particular public attention because of their size, products, or services provided. So it usually applies to huge conglomerates, huge groups that you get to see, all the big names, in the consumer product sector, for example, famous all over the world. So those are the big companies, the multinational companies that we usually go through this as well. All right, so we'll now move on to June 2015. And we will spend 10 minutes trying to read and understand what are the question requirements. So we will just look at part A here. So what has happened in this, I'll just give a small brief. What happens is that this is a group audit situation, and you are auditing the group, and as part of the information that is provided, there are some issues at the subsidiary level. So those issues have now come up to you. You are part of the group engagement team. You have received certain issues with regard to the components, and you now have to deal with those issues, and you have to see the impact on the audit report. This is how usually the procedures question is asked in part of the group or component audit situation. So let's discuss this. We'll take about 10 minutes to read the question requirement and also to make an answer plan for this, after which we will do the debrief. Do note that the part that you are supposed to do for this question is the question to part A only. So we're just talking about part A only, and it is 10 minutes. The clock has started. 10 minutes. All right, time's up, and we will now discuss the response to this question. The type of question that you just saw, matters to consider and evidence expected to be found in the file, is something that is frequently tested in paper P7. One common mistake that many students make is believe that maybe these are the same thing. They are not, and that is why they're written in the question of comment separately. Matters to consider and evidence expected to be found. First of all, we need to be aware of what are the difference between the two, and that arises from the plain English grammar. And that is that matter to consider would relate to the type of risk that you have, that you're looking at, and the procedure that you would need to perform. And for this purpose, you would be looking at what procedure has already been performed, and that is listed in the question or comment, and what further could be done. Perhaps you would also want to have a look at the financial reporting rules. So you would also want to mention IAS and IFRS as part of matters to consider. However, evidence expected to be found in the file is actually that tangible piece of evidence in the file. So it is like the English grammar that I was talking about. It is like you do a verb. So a verb is like an action which you are doing, and as a result of that, something happens. So for example, that is saying that I wanted to do a balance confirmation. Now, doing a balance confirmation is a procedure, right? But the confirmed balance written on a piece of paper is my evidence. And this is one key thing that needs to be kept in mind. What is the difference between the procedure and the evidence? A procedure will be written in the form of a verb, a V-E-R-B, a verb. It will be an action. So, I am walking. That is a verb. The result of this is that I am from that place to this place, right? So similarly, I am getting a confirmation done. So this is, I'm sending out a confirmation request, getting it authorized by the company, then the confirmation letter is going to the party, and then the party is going to have a look at it. This process that I just did, and then I received the confirmation, this is the procedure, the verb, the action, the procedure. However, the confirmed balance on a piece of paper that says, yes, I have to pay $100, tick, correct, that is fine. This evidence in my file is the noun in terms of the English grammar, and that is in my file as an audit evidence. So that would classify as evidence. Now, the key problem here is that many candidates tend, whenever there are questions about procedure or matters to consider, start writing about the evidence. Or otherwise, whenever there is a question about what is the evidence expected to be found in the file, start writing about what are the procedures that need to be carried out. And this is the more common mistake. So whenever you are asked about evidence expected to be found in the file, you are not going to talk about the matters to consider or the procedure. Rather, you're going to talk about what will be placed actually in the file, the hard file or the computer-based file, within the parameters of the question or the scenario that has been asked. Now, coming to this question. If we turn to the marking scheme, and for this purpose, I would request you to go to page 23. So this page would look something like this. And you go to page number 23. So you'll find out in the marking scheme, and as we said yesterday as well, that we want to review the sufficiency first and then the appropriateness of the answer. So on the sufficiency part of the answer, we talk about two arrangements. There was one, a sale and leaseback arrangement from the other group. And second, there was, after a discussion of materiality, the question of whether there was control on a subsidiary or it was just an associate. So as you can see in the marking scheme, that they have separately mentioned matters and evidences. So there is a separate talk of matters and a separate mention of evidences. And now in the sale and leaseback, the matters to consider would, number one, we usually correct determination of materiality. This is like a free mark that is usually available for each time you come up with a matter to consider question. You must talk about materiality if it is already not mentioned over there. So you comment on whether this transaction results in a material or a possible material adjustment to the financial statements. Substance of transaction is a financing arrangement. Of course, it was in this case. and it appeared to be not an operating lease but a finance lease back. The reason for that was that various factors that were given that would lead to the lease being classified as a finance lease. Assets and liabilities were understated and profit could be overstated, which is the matter to consider as I talked about for the risk. And adjustment is recommended to the financial statements. There could be implication of the audit report if this is not adjusted, and depreciation should be mentioned. Now, why did we talk about the audit report over here? That is because in the question, it is clearly mentioned. If you look at the question, so the question clearly states that in respect of the issues described above, comment on the matters to be considered. Explain the evidence you expect to find in your file and the review of the audit working papers. So, in the terms of matters to consider, it is also a matter to consider that what will be the impact of this on the audit report. But that does not mean that in every matter to consider question, you start talking about the impact on the audit report, because sometimes the question could be set at an earlier stage of the audit, and that is the stage where you are not actually talking about the audit report. It could be at the planning stage of the audit, or just when the execution stage has actually started. But in this case, the question will come was slightly different. Why? Because you were auditing, you were part of the group audit engagement, and this group audit, which is the ACCA group, you had been assigned to act as manager. However, the draft consolidated financial statements are already there, and the numbers of revenue and profit is already mentioned over there, which indicates the fact that perhaps the draft financials are ready. And then, of course, these are these issues with regard to working papers, two issues on your subsidiaries. So then, as you look at the evidence on the marking scheme, going back to the marking scheme, page number 23. So the evidence that you see here is that a copy of the lease signed by the lessor. Now look at the difference in language that is being used. So it is a copy of the lease rather than review the lease agreement. If you say review the lease agreement for XYZ, terms, conditions, calculations, or you say calculate the amount of interest expense per month, that would be a procedure. But if you say the lease agreement, a copy of the lease agreement, that is an evidence. So evidence is what is tangible, the hard copy file, or in the computer-based working papers and soft copy, what is in file. Whereas procedure is the verb, the action, the thing that you are doing. So performing a confirmation, reviewing the lease agreement, recalculating their expense, all of these are procedures. But the recalculated version, the depreciation that has been calculated, the put in file, that is the evidence. Similarly, for part 2, you see, was the question on materiality, and after that you had to move on to the determination of whether there was control over the group or not. So if you had control, whether or not it is to be recognized as a subsidiary or an associate. If you have control, which is of course power, and then that would determine that this is a subsidiary, and that is an important matter to consider. You also need to determine the nature of the group's interest in Patrick. What kind of participation do I have in that group? This is also an important matter to consider. And the impact on audit opinion is at least qualification due to material misstatement, because of course everything in the financial statements would be materially misstated as a result of this issue. Discussion of impact on group profit if Patrick is treated as a subsidiary. There could also be not just that, but also presentation issues, and that is going to be awarded with a separate mark, as you can see in the marking scheme. And the impact would be pervasive in combination with the sale and leaseback. So you also did have an additional point for discussing the parts A1 and A2 in combination. So first you discuss A1 separately, then you discuss A2 separately, and then you get an additional point for discussing A1 and 2 combined, because they combined could have a pervasive effect and not just a material effect on the financials. And then the same that we just discussed with regard to evidence in the file, you can see the wording is different on evidence, and that is agreement of the cash pay required, review board minutes, review legal documentation. Now it says here review of legal documentation. So reviewing the legal documentation will become a procedure, but the reviewed legal document in your file would actually be the evidence. Note of discussion with management regarding the exercise of control. Review of forecast, the budget and the forecast that has been reviewed would be placed in the file or the notes thereof. Ensure that losses from the date of acquisition only are consolidated, and evaluation and recalculation of amounts recognized in group equity in respect of parent company, in particular the determination of pre and post acquisition results. So as you can see, that group audit questions do come up with a flavor of financial reporting rules. It is not important that they will only be tested with regard to the theory aspects of ISO 600. Usually that is not there. Rather, it is done in the context of a scenario. So always remember that at the P7 level, you should expect that group audits are likely to be examined at the level of through a scenario, and in that scenario, that's the way where you have to apply your knowledge and not just reproduce the knowledge of the ISA. And so in this kind of question, all the theory that we just discussed about ISA 600, what is a group, what is a component, who is the group engagement team, the group engagement partner, what are the responsibilities of each, how the communication works, all of that does not actually have relevance. Why? Because you will have to apply all that knowledge about communication and matters to consider and evidence to the scenario that you have, rather than reproduce all of that knowledge. So candidates who try to reproduce the knowledge from ISA 600 would possibly not have gotten all the required marks, and they would have possibly not passed in this at least question. So this is the area that you need to consider. There is also one more question which I am going to give to you as homework, and I strongly recommend that you work on it, and that is question number 5 from the same paper. So this is question number 5, and I just read the first line so that you're aware of what I'm talking about. It is, you are a manager in the audit department of Nij and Company, a firm of chartered certified accountants responsible for the audit of Darren Company. So it's June 2015, question number 5. You can see this on the slide in front of you, and we will do a little discussion required on the next day. But it is important that you do practice this, so take out the time to do it. And I hope that today's session, there was lots of slides and lots of content had to be covered today. But hopefully, after having done all of this, we are almost done with the assurance and auditing part. So what we left with on the assurance part for tomorrow is just the key audit matters and reports, the audit reports part, according to which we'll also do a question for that. After which we will move to the non-assurance areas. So if there are no questions until now, or no questions for now, that is good. So I will see you tomorrow, hopefully. Have a good day and good night.